Much, Maria Tadeo there in Bonn with the German finance minister. And Mark, interesting that the focus there on Ukraine, of course, and talking about relations with Russia, but also saying that he wants to adopt a neutral fiscal stance. I thought that was interesting in the context of what governments can do and can't. He was at pains to point that out around higher inflation.
Yeah, I'm curious to see if we can get greater coordination around the inflation problem, because it really is a global problem, and we don't want countries starting to do competitive currency devaluations. We don't want them following different tactics. We want them all acknowledging it's a global problem. So I do think it's really interesting to hear what the G7 stance is about that. And as you say, we follow the monetary policy side, but what they're going to do on the fiscal side to address some of those problems and for the economy as well and the real world impacts.
Yeah. Absolutely. So a lot to focus on at that G7. Maria Tadeo bringing us coverage. Thanks to Mark for spending the past hour with us. European equity markets then just opening up for Friday's session. Futures have been pointing higher. Tom McKenzie joins me here on set, of course, to take you through the next hour of programming. He'll get us up to date with the start of trade. Tom.
Yeah, Anna, so the PBOC coming in and making its move, lowering the benchmark LPR, that benchmark interest rate for the Central Bank of China, to a record low, with the context that this was reconfigured in 2019. So that's how far it goes back, just to 2019, but nonetheless came in below what many of the estimates had been. And so that is supporting the markets, and it really does just underscore the differentiation you're seeing between the PBOC and the Federal Reserve now, both going in opposite directions. And officials from the Fed this week have just underscored and reiterated their determination to continue with rate hikes despite the volatility we're seeing in the markets, despite the drawdown we've seen across equities. US and stateside ending modestly lower yesterday. The futures, as I say, being given the juice on the back of that PBOC move. And you're seeing now the FTSE 100 up 1%. By the way, a mixed picture when it comes to UK consumer sentiment. The sentiment survey suggests that it fell to the lowest since the early 1970s. Consumer sentiment taking a real hit, but retail sales coming in with a surprise beat as Brits stocked up on booze, cigs and sweets. In terms of what's happening in Spain, you're seeing gains of 0.7%, similar picture in Italy, and the German DAX is gaining 94 points. You heard there from the finance minister of Germany saying that the G7 has agreed to an additional $18 billion of support for Ukraine, and he wants to see, when it comes to inflation getting back down to 2%. Let's switch it over and see how things are playing out then across assets, given the picture that we saw stateside yesterday. Modest weakness. The futures pointing to gains of 0.5%. The pound in focus for us, given that mixed picture when it comes to the retail sales and the retail sector consumer sentiment. 124 on the pound, just up 0.1%. And the US 2-year, 263, a very modest move in terms of the yields, lower by up by 2 basis points. So you're seeing a bit of risk on, again, being articulated across the bond markets. Iron ore, and this is pronounced in terms of the move, gains of almost 6%, linking that to what is happening in China on the back of that move by the PBOC to cut the loan prime rate. Let's switch on and see how things are playing out across some of the individual corporates. We're still getting earnings coming through here in Europe. Richemont missing with its earnings and pointing to the hit that it's taken from Russia, about 168 million euros, but also pointing out that 40% of its stores in China, that crucial market when it comes to luxury, currently closed. So the hit there from COVID-0 as well. EDF and an update in terms of the Hinkley power plant. plant. They're extending the timeline for when this reopens, or when it starts, I should say, and increasing the costing to above 25 billion. So we're just watching EDF on the back of that announcement, currently unchanged. Air France, KLM agreeing and looking to Apollo for about a 500 million euro capital injection for that airline, getting 2.2% on the back of that move. Okay, let's get over to Bloomberg MLive Managing Editor Mark Cudmore now. Mark, you've been looking at Hong Kong stocks for us this morning.
Yes, Tom. Long-term viewers will know I'm quite constructive on Hong Kong stocks. I'm one of the few people out there who thinks they're already so discounted that they don't have loads of downside. And if there's a little bit of positive news in Greater China, Hong Kong stocks potentially have a lot of upside. They are essentially a play on the Chinese economy, but they're actually cheaper than some of the mainland shares. This is a chart of the Hang Seng Index versus the S&P 500. Now, this is going back over the last 3 years, and you can see it's been very much a one-way trend. And if you actually looked at this at a longer-term horizon, it's fallen even further. But I think that this ratio might have put in a long-term low in March. Now, since March 15th, the relative outperformance of the Hang Seng Index is about 20%. And what's happened is it's rallied about 12% since the low back in March 2 months ago, and the S&P 500 has fallen another 8.5%. And it's interesting that the Hang Seng has managed to rally that much in this environment where most global stock markets are really, really suffering. So I think, as we're just breaking this kind of trend line, Hang Seng is still much, much more discounted. It's a very discounted stock market. U.S. stock market, despite its recent weakness, is still expensive on a PE basis. So I think there's a lot of upside to come in the months and years ahead. One qualifier before I go, I probably would have said the same thing if you'd shown me this chart back in this period and would have thought this was the long-term low. Luckily, I didn't, but I'll admit I would have claimed that.
Mark Cudmore making the case beautifully there for Hong Kong stocks with the valuations suppressed there, the opportunity versus US. Thank you. Managing Editor for MLive, of course, Mark Cudmore. Let's get into more of these market drivers then with Bloomberg's Equities Editor, Kat Van Hoof. Kat, thank you for joining us. Let's talk about China making its move then with this cut to LPR. Is this the pivot point for China? Is this the support that we've been looking for that economy and for the assets over in China?
Well, I think it's definitely been supportive as we've seen a bit of a rally in the Chinese equities benchmark for sure. But I don't know if it's going to do much to help the structural issues that are still facing the Chinese economy. We're really dealing with a bit of trouble for economic growth for the Chinese economy. So I don't know if this is going to be anything really structurally majorly helpful for Asian equities and China in particular.
So presumably, if you don't get that structural help through to the Chinese economy, not much of a read across to Europe, where so many of the corporates are dependent. And we just had a reminder of that. It's not just the autos, but also the luxury space, of course, and Richemont saying that 40% of their stores in China closed. Is there any read across? Is there any upside for Europe on the back of this?
I think it will be helpful for sentiment to a certain extent, but we might see a little bit of a relief rally, but I don't think it's going to be particularly long-term. We still have lots of headwinds facing European equities. Inflation is, very soaring everywhere across the board. Lots of worries about economic growth. Definitely supply chain issues are still very much weighing on sentiment, and I think investors are very much, the risk of recession is looming large in their minds.
What do you make of what's happening with the UK then and the retail picture? The FTSE 100 is the outperformer just in the first few minutes of today's open, gaining 1.2%. Mixed picture when it comes to consumer confidence versus retail sales. What should we read into this?
It's a little bit difficult to predict, obviously, but I think for UK consumers, this is a long-term issue that's really going to weigh in the next few months. So it's a bit difficult to extrapolate too much from 1 month. I think for sure we're going to see the cost of living crisis, which is intensifying, is only going to weigh more and more as time goes on, I believe.
Okay, Kat, thank you very much for walking through some of the key themes. There's a lot to work through this morning. Kat Van Hoof, thank you for that. Let's bring in now our markets guest, Patrick Armstrong, CIO, of course, at Plurimi Wealth, I should say. Patrick, good morning. Thank you for joining us. I want to start with that question that I put to Kat there on China. Is this a pivot moment for Chinese assets?
I don't think it is. It's if you want to be an optimist, this is the beginning of the start of a number of measures they'll put in place to get their economy rolling again. They still have an official target of 5.5% growth, which there's no way they can achieve it with real numbers, given that they've got the zero COVID policy. But it does show that they're not asleep at the wheel, that economic growth is still on the agenda. And if this is the beginning of many steps, including a reopening of the economy, that would be something that would get me very bullish. But I'm not sure it is that yet.
Okay, still need the opening of the economy really to turn our sentiment on China. Just a redhead that's crossing your terminal right now, Patrick, and we'll maybe get your views on the luxury space. So Richemont, on the back of that miss in terms of earnings, dropping 10% again after the earnings and that outlook forecast and update from Richemont. It's a reminder again of the corporate exposure to China, Patrick. The markets, they clearly, this suggests that the markets have not yet priced in the full impact of the slowdown that we're seeing in China and what it could prove to be in terms of the drag on some of Europe's corporates.
Yeah, I think it's always shocking to see the numbers. Everyone knows that you've got shutdowns in Shanghai, Beijing, shutdowns looming, and that obviously has massive impact on retail spending and the amount of customers that are allowed into shops. If the shops are allowed to be open, it's going to have big impacts. These kind of companies, they do see a catch-up when things reopen, though. So it's a big hit on the quarter. I do think they're in the following quarters, when China eventually does reopen, there will be a very strong catch-up as well. So I think the market might be overreacting to this right now.
Okay, interesting. Maybe a bit of an overreaction to what is happening for Richemont. Patrick, when it comes to the S&P 500, we're looking, the futures are pointing to very modest gains today, but still we're looking at a 7th straight week potentially of declines for the S&P 500. Do you think the Fed blinks at this point, Patrick, when they look at what is happening, the rout that we're seeing across US equities?
I don't think they're at the blinking moment yet. I think they'll get into the summer months and come to September, and I suspect that's when they'll blink. So I think you've got 50 basis points in June and July. The Fed will assess where the market is, it'll assess where the economy is, and if they've seen inflation plateau and start to roll over, I think they're going to err on the side of letting inflation run hot rather than provoking a recession, but they're going to have to decide which policy mistake they make. They're either going to have inflation persistently above their targets or provoke a recession. The window to get in between that and that softish landing that Powell's hoping for is so small, I think it's next to impossible.
Next to impossible to engineer that soft landing. Patrick Armstrong, CIO at Plurimi Wealth. We are very fortunate to have you staying with us over the next few minutes. We'll come back to Patrick and his calls after the break. And coming up, Chinese banks, as we've been talking about, cut a key rate by a record amount to try to boost the country's ailing economy. We'll get the details on that, the implications. But next, as Richemont slumps by 10% after earnings, we dig into Patrick Armstrong's stock picks. Stay with us. This is Bloomberg.
About what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open. Happy Friday. You are watching the European Market Open here on Bloomberg TV. You're seeing gains across European equities of 0.8%. This is after the Central Bank of China lowered its benchmark rate to a record low and well below what most economists had expected. The outperformer in terms of the indexes here in Europe is the FTSE 100 gaining 1.3%. You had a mixed picture in terms of consumer confidence, but retail sales coming in as a beat. Basic resources, by the way, up at 2%. Iron ore, certainly a component there, gaining the last time I looked more than 5%. But from basic resources to luxury now, Richemont reporting full-year earnings that saw operating profit for 2022 more than double compared to 2021, showing the luxury maker's strength in the face of lockdowns in China and Russia's invasion of Ukraine. Bloomberg's Laura Wright has been across the results. We've seen the stock take a hit this morning. Laura, what were the key takeaways?
Well, I just want to say, Tom, it's Christmas in 7 months. It's my birthday in 8 months. So if you fancy taking a look at any of Richemont's brands, that definitely works with me.
We'll be putting the orders in for you, Laura. Just make note of that, newsroom, please.
We're all making note. But on a serious note, Richemont being hammered in early market trading, down double digits. Asia Pacific is the luxury maker's largest market. Rolling lockdowns in China are continuing. 40% of their store network remains closed. There was a bright spot regionally. That's the United States, with constant currency sales growth up 77% for 2022 compared with the same period in 2021. The hit from pulling out of Russia was pretty much priced in, but still around 170 million euros taken off profit as a result. And if we look at Richemont's key divisions, jewelry, watches, other, you'll see that jewelry is still the largest contributor to overall revenue. And it's interesting for Richemont because LVMH's acquisition of Tiffany, while it created a competitive headwind, it also stimulated the market, which was beneficial for Richemont's businesses, including Cartier, Van Cleef & Arpels. Watchmakers, 50% constant currency sales growth in 2022. The United States is now the world's #1 luxury importer of watches, overtaking China back in October. Other businesses includes brands such as Chloe and Dunhill, fashion, leather goods. Online is notable. Traditionally, Richemont has struggled online with its Yoox Net-a-Porter business to generate profitability. They tried to bring on board other luxury heavyweights such as LVMH and Kering, but they were reluctant to join on board a competitor platform. But we learned that Richemont is still in talks with Farfetch, another luxury online retailer, about potentially taking a minority stake. So it'll be interesting if that does in fact take place.
Okay, Bloomberg's Laura Wright on those Richemont earnings. Thank you. Let's dig into some individual stocks then with Patrick Armstrong, CIO at Plurimi Wealth, who is still with us. Patrick, let's start with luxury. Do you like that space?
I like it. I don't love it, but if you look at all of those headline volumes growth or sales growth, it is incredible. And if you understand the macro backdrop we're in, it's stagflation. Growth is slowing and prices are increasing. You don't want to own companies that are price takers. Richemont and LVMH, these are price setters that basically their cost of goods sold is almost irrelevant to the end sales price. So when input prices jump, this sector isn't impacted at all because the profit margin is so high and they're defendable margins. They've got the power of the brands, and it's very attractive over the long term. Short term, you've got issues with Russia. That's a complete write-off pretty much right now. But in China, there is going to be pent-up demand. Then there will be a catch-up on that.
Okay, before we get into some of your individual picks then, Patrick, I want to take a listen to what we've been hearing from Citadel's Ken Griffin on the case for value. Take a listen.
What we're seeing in the markets is a rotation from growth stocks with earnings very far in the future towards stocks that are much more value stocks, earnings here in the present. And this reflects the fact that real rates, for the first time in a very long time, are likely to go positive in 2023.
Patrick, do you align with that view? Is there more legroom, more room to run for the value space?
There is. We're like in 2001 right now, where the market isn't going to be massively directional, but the stocks that don't have earnings and trading at very high multiples, infinite multiples, that had business models that they would eventually generate earnings in 10 years, we're in an environment that's going to continue to punish those kind of stocks because the market rewards earnings today, cash flows today. We've got an environment where yields are moving higher, there's inflation. Companies that are producing cash flow today, you can make the case for. My playbook is basically the equities I own trade at 10.5 times earnings. The equities that I'm short are trading at 36 times earnings. And not only are they trading at 36 times earnings, I think they don't even have a path to profitability, a lot of them. That the market, when interest rates were zero, rewarded companies to IPO that had no path to profitability. Their prospectus even said, we don't have a business model that's going to lead to profitability in Uber's case. And the moment Just Eat raises its price to a level where it can break even, it loses 100% of its market share. Same thing with Delivery Hero. These are hyper-competitive markets where companies are just selling goods below their costs. So that's why you're getting revenue growth.
Okay, so that's what you're avoiding. You want to see that multiple compression if you're looking to dip your toes. What is looking attractive? What are some of the stocks that you're calling out at this point, Patrick?
Most of our recent buys have actually been in the agribusiness sector over the last 3 months. That in December, a farmer expected to make $6 a bushel for wheat. Now they're expecting to get $12 a bushel. Basically, with Russia and Ukrainian wheat not being able to get onto the market, there's going to be, in Australia, Canada, America, farmers are going to plant every acre of arable land they have. They're going to farm the less fertile land that requires more intensive farming, more potash, more fertilizers, pesticides, more farming equipment, and they're going to have a lot of cash flow to do all those things as well. So I think agribusiness stocks are getting a very strong tailwind from what's the consequences of the Russian invasion of Ukraine.
Okay, Patrick, before we let you go, it's worth noting, by the way, that Patrick's fund was up about 3% in April, so clearly outperforming the benchmarks, Patrick. When it comes to our MLive question of the day, question of the week, it is this: where is the bottom for the S&P 500?
I think we're getting close to it, actually, but it's going to be a lot of moving parts underneath. I think the high multiple stocks are going to continue to weaken, but there's a lot of companies that are representing very good value right now. And if we do see the Fed blink by the time we get into Q4, which I expect, that might set the stage for a bit of a Q4 rally. So we might have a little bit of near-term weakness, but I think we're going to end the year slightly higher than where we are today.
Okay, we'll leave it on that modestly optimistic note from the always excellent Patrick Armstrong, CIO at Plurumi Wealth. Thank you. Okay, coming up, China cuts its long-term interest rate by a record amount in the hopes, of course, of boosting its ailing economy. That story is next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Be PSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit pso.org/now, where the music plays on. PSO season sponsor, Bank of America.
Welcome back to the Open. We are 23 minutes into the European trading day. Some solid gains across European equities of a little over 1%. The standout is the FTSE 100. 1.3% is the gain there. Iron ore and basic resources powering that upside. Iron ore currently up almost 6% on the back of the story out of China, which we'll unpack for you shortly. The future stateside, the S&P E-minis gaining 0.8%, and the Nasdaq futures up currently at 1.2%. So risk on, despite the concerns this week about the trajectory of rate hikes and inflation, indeed the questions around recession. Talking of which, China has cut its 5-year loan prime rate by a record amount in the hopes of boosting its ailing economy. The move would reduce mortgage rates, costs, and could drive loan demand hit by lockdowns and a property slump. For more on this, we are joined by Enda Curran, our Chief Asia Economics Correspondent in Hong Kong. Enda, we talk about a record, which indeed it is. Of course, the context was and is that it was reconfigured in 2019. What do we make, though, of this oversized move by the PBOC?
Yeah, it was a bigger than expected move, Tom, a 15 basis points reduction. It is material and it goes to the heart of the real economy. Remember, COVID-0 hasn't been the only thing dragging down China's economy. It's been the real estate slump through much of last year. So this will certainly take pressure off mortgage holders, and it might, as you mentioned, perhaps generate demand for new mortgages. House prices have been falling. We know the big property developers remain under a lot of pressure. We can even seen defaults there. So it certainly will be a help to the property side of the economy, which can be anything up to 25% of overall GDP. But of course, this move in and of itself isn't going to be enough to turn around the whole economy. All of that will depend on COVID-0 and how that plays out.
Yeah, continuing to watch how things moderate in terms of those restrictions. And our crack team at Bloomberg have worked out that we've had about $5 trillion of stimulus, fiscal stimulus from the Chinese government to try and support the economy. Then you've had this PBOC move. How much of that, do we have a sense of how much that is actually filtering into the real economy, and what other policy tools are currently at their disposal?
We're not seeing much traction yet, Tom. I mean, take, for example, what they're doing with the money markets when they bring down some of those lending rates. For example, the financial system is already flush with cash, and there isn't enough demand there for lending anyway. We saw a big drop in credit in the month of April, for example. So not much traction yet on the policy side. The other issue pushing against what they're doing, of course, is the ongoing restrictions. Even if it's not a lockdown, there's a lot of disruption to daily life due to the testing procedures that are now being commonplace right across the economy. So there's a feeling that China's policy wheels are spinning in the sand a little bit. The authorities, of course, haven't yet gone gangbusters either with stimulus. They're nowhere near the levels of what they rolled out in 2008. And of course, they're still being fairly restrained compared to past downturns in the time since that period too. So when you put it all together, it really does come back to COVID-0. Either they get the virus under control, which of course will allow the economy to get motoring again, but that's being really tested by Omicron and how transmissible it is, in which case there will be ongoing disruptions and ongoing lockdowns, and then you have to question just how much stimulus will be needed to turn that around when you continue to start the economy the way that they are.
Enda Curran, thank you so much for breaking down what is happening in terms of that policy response out of China. Our Chief Asia Economics Correspondent in Hong Kong. Coming up, G7 finance chiefs are meeting in Germany with funding for Ukraine front and center. We are live in the city of Bonn next. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Surprise stimulus. Chinese banks cut a key loan rate by a record to boost the economy. Global stocks push higher on the unexpected reduction. No sympathy from the Fed. Kansas City President Esther George says rough markets will not deter the FOMC's tightening plans. Plus, inflation anguish. UK consumer confidence strikes the gloomiest reading since the 1970s after a surge in the cost of living. But defying the gloom, April retail sales unexpectedly jump. Let's take a look then at which sectors are on the move as investors digest that bigger than expected drop in the loan prime rate out of China. A boost potentially, as Enda Curran was saying, for mortgages, the real estate sector and short-term loans. But how does that actually filter into the real economy when so much of it is still restricted, if not fully locked down, by everything that's happening in COVID-19, COVID-0, I should say, and how they're trying to control that. Basic resources is the top of the pack when it comes to your sectors, gaining more than 2%. Iron ore, by the way, up around 6%. That demand expectation out of China on the back of looser policy. There has been this focus on spending around infrastructure, and whether that drives demand for iron ore is clearly part of the factor that is mixing into what is happening with the iron ore. Basic resources getting on the back of that. That's feeding into gains for the FTSE 100 as well. Autos and parts also up more than 2%. Energy as well, 1.6%. And we'll talk about energy shortly around the G7. And at bottom of the list, just one sector in the red this morning, consumer products. And again, just reiterating that Fed officials this week have made no signs that they're going to be walking back from rate hikes, despite the fact that you've got the S&P 500 on track for a 7th straight week of declines, which would be the longest streak of declines in over 2 decades. Now let's turn our attention to what is happening in Germany, in Bonn, where G7 finance chiefs have agreed on more than 18 billion euros in short-term financial aid for Ukraine. Maria Tadeo spoke earlier to Germany's Christian Lindner.
We are fundraising to secure the liquidity of the Ukraine government, and it appears that there will be more than 18 billion we can raise to support Ukraine in this crucial historical moment. And I think it's a very good signal that the G7 nations are standing shoulder to shoulder to Ukraine, because they are not only defending themselves, They are defending our values.
And of course, Germany has said that, and you yourself, you've spoken that this country is going to need a Marshall Plan, a huge reconstruction. But just on the short term, you're putting forward 1 billion euros. You've said you're going to commit with that. Now you talk about a communique that says 18. Who is funding this gap in between the 1 and the 18? Is it G7? Is it also European EU money? What's the combination here?
Yes, it's G7. For example, the $7.5 billion the U.S. Congress had decided, and in addition, the EU programs, and this sums up to more than 18 billion. And if we use the capabilities of the IMF, I think for the foreseeable future of the next month, there shouldn't be any concern of the Ukraine government to finance their state's needs.
So what you say is that for the next 3 months, presumably, Ukraine is not going to have any issues paying for this basic needs. You don't see any funding problems for the country.
For the foreseeable future of the next month, I think the problems are solved. And we are standing ready to observe the situation. But at the moment, I think we made a very important progress on guaranteeing the liquidity of Ukraine.
And of course, you know, this is one issue, but in this G7, being the German finance minister is always difficult. You have to deal with a big industrial country. Then, of course, now concerns about inflation, concerns about monetary policy changing. Yeah. When you look at the whole picture, what is the issue? I think I have an idea of what concerns you the most. But what is the issue that you're focused more on? Is it inflation?
It is inflation. In the short term, it is inflation. In the long term, we need sustainable growth for all of our economies. We have to rehabilitate growth in a sustainable, inclusive way. It's a long-term project. We have to finance transitions to a greener economy, digitalization. We have these special challenges for mankind. But in the short term, we have to deal with rising inflation rates. This is, I think, it's key for our economies that we reach again the level of 2% inflation rates. Now we have to take tough decisions. On the one hand, the central bankers, and on the other hand, the governments with their fiscal policy measures.
Okay, that was, of course, our Europe correspondent, Maria Tadeo, speaking to the German finance minister. Let's cross over to Maria now for more on this. Maria, a great interview, some solid insights there from the German finance minister. What do we know about the details about this aid package, then, that's been agreed to?
Well, I think, Tom, he gave us two very good indications. One is that there will be a communique by the end of the session today in which the G7, alongside the European Union, at what point he also talked about the IMF, will be able to bring in together more than $18 billion for Ukraine. A lot of this, of course, is about the short-term funding for this country. Remember, the Ukrainians had warned, and they had said over the past couple of weeks, that they're in the need of $5 to $7 billion on a monthly basis. And this is just essentially to make do on their payments, to be able to cover basic expenses. I think he was very clear. They're saying there will be an agreement on that 18 billion mark, but also, and this to me is even more important, he suggested that there won't be any liquidity issues for Ukraine over the short term. He told me, I think for the next foreseeable months, this issue, quote, is solved.
And he talked, of course, to you about his focus on inflation, trying to get it back down to 2%. How much coordination is there actually happening amongst the G7 on the question of inflation?
Well, Tom, you know, I have to say, for the past 48 hours, I've been kind of here submersed in this G7 experience where you only talk, of course, about the big macro issues happening, and it's finance that you talk about all day. There's two big points that come up all the time. One is this Ukraine-induced recession. The other one is inflation. I would say this has been, in many ways, the big talker on this conference. You hear it from the finance ministers. You hear it from the central banks. Concerns, perhaps, that central banks risk losing some of their credibility, that they're behind the curve when it comes to the European Central Bank. A lot of debate around going back to normal, that at this point, really with inflation on a very upwards trajectory, the ECB has to get tough, get a hold of this, and perhaps do it quickly. You know, I think they want to be seen as being on the same page. But if you look into the details here, there's still divergence, particularly when you look at the two big central banks here, the Fed, the European Central Bank, of course, moving at a different pace. But a lot of pressure, I think, on the Europeans to really show that inflation now, they take it serious, and it's not just about the words, but actually acting on that inflation print.
Yeah, and presumably Germany will bring all of its historical focus on inflation to bear within that discussion. Maria Tadeo on the ground for us in Bonn, thank you. And on the question of liquidity, because Maria was reminding us of the importance of those comments from the German finance minister about his lack of concern about Ukrainian liquidity, that will continue, at least in the short term. Just interesting to see there's a redhead crossing the terminal now, which is in some ways linked to this. Ukraine saying it's mulling reviving interest rate decisions as early as June. We will bring more details on that to you when and if we get it. Okay, Europe's effort to stand up to Russia is being slowed by two strongmen leaders, Turkey's Erdogan and Hungary's Orban. Both men are insisting on the priority of their national interests and playing to domestic audiences. Joining us now is Bloomberg's senior reporter for international affairs, Mark Champion. Mark, what is going to take, let's start with Turkey and Erdogan and the fact that he's proving a roadblock, at least to this NATO expansion. What will it take for Erdogan to accept Finland and Sweden into this military alliance?
Yeah, well, on the surface, what it takes is for both countries to change their policy on some of the Kurdish groups. So there's this sort of panoply of Kurdish groups within Turkey. It runs from the sort of, plain vanilla, from the, sort of the Western point of view, plain vanilla political parties, and it goes all the way through to the PKK, which is listed as a terrorist organization by Turkey and most European countries, the US. So the difficulty there is that Turkey's interpretation of who is a terrorist amongst Kurds is much broader than Sweden and Finland's, and it wants recognition there that it needs to change. And the second thing is much quieter, but the Turkey's in long negotiations with the US to get F-16 jets, and it's quite likely that behind the scenes there's some pressure there to try and use this leverage that Turkey suddenly has to slow the process for Finland and Sweden to join in order to get some movement on that.
And of course, it isn't just Erdogan that has leverage. It's also Viktor Orban over in Hungary when it comes to this latest sanctions package. And of course, central to that is the reduction, or at least the banning of Russian oil into Europe. Is Orban just looking for an agreement, a deal around financing on this? Is this a question of money?
Most probably. So really what he said is this is too big of an issue to be resolved at a technical level. We're going to have to make sure that our energy security is assured, and that's going to take a lot of money, and that's going to take a big conversation. So it's most likely that this won't get resolved until the EU leaders meet at the end of the month. And when they do, Orban has quite a record of, he's quite happy to be in a minority of one. He has a record of going to these meetings and just sort of pushing to get what he wants. He won't get everything he wants. He's set the price tag extremely high. And that's sort of why the sort of attempts at talks at a lower level just stopped. There was supposed to be a video conference with the leaders and to try and sort of work something out. There was supposed to be various levels of negotiations going on, but they've more or less stopped. And there is something going on in the background to prepare for the summit, obviously, but most likely this won't get done until all the leaders are around the table.
Okay, so we'll look to the end of this month for potentially movement on that. Bloomberg senior reporter for international affairs, Mark Champion, walking through the leverage that's being put to play by Erdogan and Orban over in Hungary. Coming up, consumer confidence in the UK falls to its lowest in almost 5 decades. That's a soaring inflation raises the risk of recession. That story and the details next. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Welcome back to the Open. We are 45 minutes into the European trading day. It is risk on across European markets. Futures stateside also pointing to gains. You're up 1.3% now across European equities. China wading in with that cut to benchmark rates, and that is hoping to support sentiment this Friday morning. Talking of sentiment, let's switch focus to what's happening in the UK. Consumer confidence here has fallen to its lowest in almost 5 decades. Research company GfK said its closely watched gauge dipped 2 points in May to -40. That's the least since records began all the way back in 1974. While April retail sales figures, which dropped at the top of the hour, defied the gloom by rising 1.4% from a month earlier. Joining us now to work through this data then is Charles Allen from Bloomberg Intelligence. Charles, what are the key drivers then behind this data, which on the surface looks quite mixed?
Yeah, well, I mean, I think one thing you've got to look at is that, I mean, year on year, spending on motor fuel was up 39%. And this is money that consumers don't want to spend. So this looks good maybe in the retail data, but it's not great for confidence because you're spending a lot of money on something that you have to but don't want to.
And there's a gap as well between value and volume. Just talk about the significance of that and how that's playing out.
Yeah, is that, I mean, we already knew that inflation has jumped. I mean, we saw that a couple of days ago, but you're really seeing this in a lot of the subsectors across retail where, you know, the value increase year on year was quite respectable, but the volume was almost flat or down. And, you know, in food, for example, we had almost flat value sales, but volume was down more than 6%. And that's not great news for the food retailers, which is a volume-driven gain.
Charles, just briefly, what are online sales looking like here in the UK?
Again, going backwards is that, you know, I mean, they're still up on 2 years ago, but year on year they're down. And so online is, people are just not choosing not to do that so much anymore. And I think we've seen that right across the board in all the sectors.
Okay, Charles Allen from Bloomberg Intelligence, just breaking down the significance, the implications of this data that we got, both on the consumer sentiment survey, but also the retail sales. Thank you for that analysis. Let's bring in now Bloomberg First Word News with Laura Wright to get you up to speed on the latest stories. Laura.
Thanks, Tom. Joe Biden has announced a new package of weapons to be sent directly to the front lines of the war in Ukraine. He welcomed the passage in Congress of $40 billion in aid. Meanwhile, a top Kremlin official has said Russia is determined to take all of the Donetsk and Luhansk regions of Ukraine. China is seeking to replenish its strategic crude reserves with cheap Russian oil, strengthening energy ties with Moscow, just as Europe works to ban imports. Sources tell us Beijing is in government-level talks with Russia to buy additional supplies with little direct involvement from oil companies. Russian crude prices have tumbled as buyers step away to avoid being swept up in financial sanctions. PIMCO and BlackRock are among the firms to start debt talks with Sri Lanka soon. Bloomberg's learned that AllianceBernstein, T. Rowe Price and Wellington are also among the members of a creditors group. Sri Lanka fell into default this week for the first time in its history. An economic meltdown has led to protests and a political crisis. By one account, the world has only 10 weeks' worth of wheat consumption left in reserve, the lowest since the 2008 financial crisis. That's according to agriculture analysis from Grow Intelligence. The firm's CEO spoke to UN Security Council meeting on food security. Other estimates are not as dire. Still, high crop prices are putting millions at risk while grain supplies fall. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
Laura, thank you. Okay, coming up, we will round up what's been, of course, a volatile week for markets and throw ahead to what we expect next week as well. That is up next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that. Bloomberg Television. Top experts. Great questions. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web. This is Bloomberg.
Happy Friday, welcome back to the Open. We are 52 minutes into the European trading day. A solid session so far with the context, of course, that a number of these rallies that we've seen in the last few weeks have been, of course, followed by pretty significant losses. So whether or not this is a bear market rally is one maybe for Noor Al-Ali, who we'll bring in shortly. But you're seeing gains of 1.3% across the benchmark European stocks. Future stateside also pointing to gains of between 1% for the S&P E-minis, 1.5% for the Nasdaq futures. A dramatic week then in markets as hawkish signals from the Fed spurred investors to prepare for slowed growth and fled recession concerns. Those concessions or those concerns were exacerbated then by earnings from retailers. Front and center, of course, was Target, that slumped after cutting forecasts. Joining us to round it all up, what a week. Noor Al-Ali, our Markets Live editor. Noor, great person to kick things off with when it comes to everything that has rankled these markets and what to look ahead to next week. First off, let's kick off with potential additional volatility with the options expiry, close to $2 trillion across the US later today.
Yeah, absolutely. I mean, there are a lot of camps here that think, oh, this is precisely what the market was selling this week because they're trying to cut gammas, and this is why, you know, we're going to see a bit of more volatility today, but next week is the week to buy the dip again. But look, I mean, I don't know to what extent that stuff is true, right? Because I don't watch technicals, and I know a lot of people really care about those levels. I do think that fundamentally we still have a very weak market driven by a lot of factors, as you've just mentioned, that it pretty much would make it really hard for me to think to be a little bit more bullish. But I'll give you a tidbit here. If S&P 500 closes down this week, it would be the longest of weekly losses since the early 2000s. And we know what happened then, right?
Yeah, almost 2 decades. Remarkable, almost 2 decades. I wonder to what extent China may come to the rescue on this front. We've heard a lot about the rhetoric. They've come through with some action with that cut to the benchmark loan prime rate today. It was a surprise. The market stepped up on the back of that. Can that be sustained? How much of a catalyst is China now?
It does boost the sentiment for today, but to what extent could that do when you still have the one COVID policy looming over China and its biggest cities where their GDP production is pretty much cut until we get out of that terrible situation that we're in right now when it comes to COVID. But the one thing to keep in mind when it comes to China as a whole is that the risk of contagion is quite high. You've got supply chain out of there. It's a big commodity buyer. And you've got a lot of inflation prints coming out of Asia next week that will give you or paint the picture of what we're going to expect in that hemisphere of the world. And I think that's quite prominent.
Interesting. So we'll look to the data out of Asia next week to see how much has been contagion out of China. When it comes to Europe, you've seen, just looking at the bond space today, a bit of a move out, bit risk on, as we say, and you're seeing that reflected in bond prices. So that divergence between bonds and equities is now starting to happen. I just wonder to what extent, just worth noting, the Italian 10-year, by the way, up 5 basis points in terms of the yield there. I just wonder to what extent bonds have now come into play when it comes to a hedge in these volatile markets. Are we starting to see a cap for these yields?
Well, the thing about bonds is what we've seen yesterday in particular was a haven play. It's a very classic risk-off haven play. The Japanese yen, the Swiss franc, and bonds definitely in Europe. An interesting note, though, UK gilts, the 10-year gilts, closed unchanged on the day. So it just shows you the outlook perhaps for the UK with consumer sentiment at a record low, quite troubling. So I do think that we'll see a bit more into that as we get into the ECB. But the July hike is pretty much priced in, I think, at the moment. And I think that's quite interesting as well.
Markets currently pricing in about 5 hikes from the Bank of England for the rest of this year. And of course, still weighing up that retail print and the consumer sentiment survey here in the UK. Noor Al-Ali, thank you so much this Friday for walking us through some of the key themes and looking ahead as well to next week. Let's just get up to speed on the market moves then that we are seeing after, as we say, quite the volatile week. The S&P 500, as Noor was pointing out to us, on track potentially for a 7th straight week of losses. Here in the UK, here in Europe, though, you're seeing gains, as you can see on the benchmark, of 1.3%. The DAX is up 1.4%. The CAC gaining 60 points. In terms of what's happening in bond markets, that risk-on sentiment being reflected as well. Yields up, so a bit of a move out of those benchmark bonds. Italy, the 10-year yields up by 5 basis points. You're seeing about a 2 basis point move on the German Bunds. Plenty more coming up. Stay with us. This is Bloomberg.
Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Yes, a recession is inevitable. The question is when, timing-wise. And we don't think a recession is likely over the course of the next, let's call it 4 quarters for sake of the argument. What we're seeing in the markets is a rotation from growth stocks with earnings very far in the future towards stocks that are much more value stocks, earnings here in the present.
President Putin's actions are what is driving the price increase at the pump. The president is focused on doing everything in his power to address the Putin price hike.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Surprise stimulus. Chinese banks cut a key loan rate by a record to boost the economy, while global stocks push higher on the unexpected reduction. No sympathy from the Fed. Kansas City President Esther George says rough markets will not deter the FOMC's tightening plans. Plus, inflation anguish. UK consumer confidence strikes the gloomiest reading since the 1970s after a surge in the cost of living. But defying the gloom, April retail sales unexpectedly jump. So first thing is first, let's check in on the markets, and there has been quite a lot going on. Volatile yesterday, of course. I was in New York speaking to Ken Griffin of Citadel. He does not expect a recession, certainly not in the next 4 quarters, but then all bets are off on what could happen. European stocks, you can see now holding strong, 1.2% higher. Really China's latest measure to try and bolster this economy injected a note of optimism in the end of a pretty choppy week. I'm looking also at pound, 124.68. A lot of the volatility that we've seen is playing out in the currency markets. The Bloomberg US dollar index 1.239. Again, if you look at some of the concerns, certainly in emerging markets and some of the oil producing countries very dependent on dollar, this is where we could see some kind of concern. Bitcoin 30,235. Now, if you look at the European map, and again, it's extremely different if you're on the energy complex and you're sitting in Germany. Maria today spoke to the German finance minister. That's different to whether you're sitting in the UK, where actually you're not that dependent on Russian gas. Also, treasury yields rising, yields on European bonds as well. The dollar, again, holding to its biggest one-day drop since 2020. The CAC 40 gaining 0.8%, the FTSE MIB 1% higher. Now, coming up, we also have a conversation with the BlackRock Vice Chair, Philip Hildebrand, on markets and central banks. So don't miss that interview. And if you have any questions for Philip, you can IB us or even tweet me at Flacqua. Now, U.S. stocks lurching lower as traders wait prospects for growth against a backdrop of rising prices, eroding earnings, and tightening monetary policy. Now, the S&P 500 fell as markets whipsaw today after the biggest single-day drop since June 2020 on Wednesday that actually erased $1.5 trillion from its market value. Investors, however, are still a little bit nervous.
The market's all kinds of in a tither.
This has been a valuation re-rating.
We had a bubble in long duration assets. That bubble is now deflating.
There could be further losses.
What we're seeing in the markets is a rotation from growth stocks with earnings very far in the future towards stocks that are much more value stocks.
We do see a lot of opportunities out there, especially with higher quality investments.
Less about the directional trade and much more about the relative value.
Everything on the fundamental front seems very much intact. 2022 estimates continue to rise.
We have to wait a little bit to see if what the Fed is doing is the right thing.
Everybody's afraid that they're going to get it wrong, and the chances are that they will get it wrong.
I don't think a recession is imminent.
Our baseline is recession late 2023, early 2024.
We're talking about 2024, maybe later.
We don't think a recession is going to happen in the next couple of quarters.
Well, we're now joined by Philip Hildebrand. He's vice chair of BlackRock and former chairman, of course, of the Swiss National Bank. And Philip, you've always given me really good chat on inflation. Of course, you believe that it was something, that can't stay here for a long time because a lot of it was imported. Has your view changed on where this inflation is coming from and what it does to consumers around the world?
I think sadly there's not enough of a sort of fundamental analysis of why we have this inflation. And I think we live in a world shaped by supply. We have, of course, more demand than supply, otherwise we wouldn't have inflation. But the real reason for the inflation is that supply is at an unusually low level as a result of the restart post-COVID and the energy shock from the war. So that's the story, and that means you have to be thoughtful as to how you're going to mitigate this inflation by way of policy.
So how should central banks look at this? First of all, is there any question that the Fed is behind the curve?
Well, I think that the key problem is in a world shaped by supply, the way I just described it, you're not going to get a perfect outcome. There's a trade-off involved. Either you have to accept that you're going to have to live with some inflation for some time until these supply problems mitigate themselves, or you have to stamp out demand so much by raising rates so much that you actually drive down inflation. But the price of that is going to be very, very high. And I think that's the part of the debate that is missing.
But you think that's a recession? I mean, if you hike interest rates to a point where you actually deal with inflation, I don't know whether there's an optimum rate for inflation given where we are now. At 4%, do you have a soft landing or do you still have a recession in the U.S.?
Yeah, that's the right question. My sense is the central banks will recognize that they cannot kill demand in order to get inflation down, so they will ease off once they get to neutral. Right now, they're talking very, very tough, and that's what's unsetting the markets. Think about it. They were on one side of the boat, completely stuck on this transitory debate, and now they've rushed over to the other side of the boat, talking about stamping out demand in order to get inflation down. So no wonder markets are rocky. In the end, I think there will be a middle path, but right now, they're trying to find that place. And what's missing, I believe, is more of a debate as to what is shaping the world right now, what is driving this inflation, and that's the supply story, the unusual low level of supply.
But it doesn't make central banks' job any easier.
It doesn't. No, I think
it makes it harder.
It's very hard for them because for the first time in a generation, I believe there's a real trade-off involved. You're not going to get to the Goldilocks outcome where you can kind of, slow demand just enough to get inflation down but not have a recession. This is a different story because it's shaped by supply. And so for the first time in a generation, they're really facing a hard trade-off. So it is a very difficult moment for them.
Philip, what does it mean for markets? So we saw this huge swing actually on S&P. I know it's a bit supported by China right now, but where's the bottom for some of these equities?
Well, I think, this boat analogy is probably pretty good. So they were on this transitory side, the central bank. Now they're rushing over to the other side of the boat. That's rocking markets. As I said, eventually, I think the market will find its way once they see what the central bank is going to do. Recession, in my view, is still unlikely in the U.S. Unfortunately, it's probably inevitable or just about inevitable in Europe, given the much greater kind of impact the energy shock has.
But you're not seeing like a hurricane whilst the boat tries to go from London to New York, right?
I think in the short term, we're going to see volatility here. The market is trying to find its way. Central banks should normalize. There's no question about this. Once they get to normalization, it's a different story. I understand why they talk tough.
Yeah.
What's missing, I believe, is more of a focus on the real reasons for this inflation, and that's the unusually low level of supply.
Okay, where's this terminal rate? I mean, this elusive terminal rate. Can we actually find it, or?
I believe that in the end, this interest rate cycle will still end up being much more modest than what inflation currently would imply. You know, we'll see. Right now, that's not what they're saying. If you look at the way the market is pricing the terminal point of this cycle, it's still pretty modest relative to history, relative to where inflation is currently. So the market isn't entirely buying the story, even though certainly the equity markets day by day are reacting very much to this very hawkish tone that we're seeing from the Federal Reserve in particular.
Philip, thanks so much. Philip Hildebrand stays with us. Now, coming up, we're also back in Bonn, Germany, where we speak with the Bank of Italy Governor Ignazio Visco. That interview is next, and this is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's turn our attention back to Bonn in Germany, where G7 finance chiefs are meeting for a second day. Well, Bloomberg's European correspondent Maria Deo is at the summit in Bonn, and she's joined by the governor of Italy Central Bank, well, the governor of Italy Central Bank, Banca d'Italia, Ignazio Visco. The words aren't coming out, Maria. Take it over.
Well, thank you, Francine. From one important Italian to another important Italian, Ignazio Visco, thank you so much for joining us at this G7, the head, of course, of the Italian Central Bank, Banca d'Italia. For the past 24 hours, the word that I hear the most here is inflation, and this need perhaps to adjust monetary policy and normalization. Those two words come out a lot. When you look at normalization, what does it mean for you at the Bank of Italy?
Well, first of all, good morning.
Buongiorno.
And secondly, well, I think we should start by recalling that we fought in the past years several risks. The risks of deflation and the risk of the pandemic generating a permanent recession. And we have been able to successfully counter these risks. Now, how did we do? Well, we did this introduce a set of unconventional monetary policy measures, one of them being having official interest rates in negative territory for a long period. Now, I think that we can move out of this negative territory for various reasons. On one side, demand is back, really, even if not as high as it was before the, well, it is more or less at the level that it was before the pandemic started. but also inflation expectations are now at around 2%, and apparently they are going to stay there. And therefore we can move, and we can move gradually, raising interest rates in the coming months.
And when you say we can move gradually, what does gradually mean to you? Is it June, July? Maybe it's not the time to put a specific month on it. What does gradual mean for you?
June, certainly not, because in
Out of the question.
In June we are still purchasing assets for our APP program, and we will end it. But clearly we also have stated, even if we are not prisoners of our forward guidance and so on, but we have stated that we will move after that. After means perhaps July, and gradual means, in my view, that we have to understand that we should move without creating uncertainty in the market. Obviously, there have been many voices in the last few weeks, and I try really to refrain from intervening too much. But I think that we should consider very carefully what we should do on the basis not only of the data, but also of the assessments, the analytical assessment that we can provide. So we should move gradually along a path which on which we really have still to decide where to settle. It is not obvious where. When, it depends very much on the state of uncertainty. We are living in a very, very high uncertainty now because of the various events, and certainly the most dramatic one being the invasion of Ukraine from Russia. We have to be dependent on the data and on the analysis. We will move, I think we should move gradually around that.
And you make a very good point saying focus on the data, but when you hear other voices that now say, well, it's 50 basis points, perhaps we can do it even faster than we thought. Is that actually a good idea to perhaps talk so much, so aggressively without new data?
Well, this is something that I've been repeating also in the Governing Council. I prefer things being discussed in the Governing Council rather than taking place in this way. On the other hand, I mean, we are obviously free to say what we think most appropriate, but then we have to look at the euro area at large. There are certain issues that clearly we have to take into account. We have to avoid inflation expectations getting disanchored. We have to avoid a wage price spiral to start without really knowing how it will end. We have to understand that we, differently than the United States, we don't have excessive demand pressures. We have substantial cost push from energy prices that started for the geopolitical tensions last year and ended up becoming permanent rather than temporary, as we were saying, because of the Russian invasion of Ukraine.
And sir, can I ask you, when you say anchor these expectations, can the market trust that the ECB will anchor inflation expectations, that you can do it, you're in a position to do it?
Yeah, I think they trust. As a matter of fact, we are having now inflation at 6-7%, and inflation expectations are around 2%. Medium term are the ones we look for, and they have to trust, because we are really fighting the risk of inflation. Even if there is this nonsensical distinction between the hawks, the doves, and so on, I think all the Governing Council members clearly see that inflation above 2% and so on cannot be a permanent features of our economies. We have learned it in the past. There are risks, but the major risk is that the purchasing power losses that are taking place because of the rise in energy costs may be considered to be met by monetary policy. Monetary policy really has to avoid second-round effects, has avoid excessive demand pressures if they materialize, but the cost push has to be countered in a different way. On one side, there is a loss that we have to accept, the economy at large, because this is an external shock.
Yeah.
On the other, there might be some redistribution effects that can take place on the part of public finances.
And on that note, the forecasts for you say are always important, but we're seeing some big divergence between the forecasts and the real numbers that come in. Why is this gap? And is there a way to perhaps adjust it and come more in line at the Banca Italia?
We do not have a crystal sphere that we really can. We do not predict the future. We may forecast, we may project on the basis of assumption. One was clearly wrong, and that was the...
And you say that, it was wrong.
The absence of the bottlenecks that were visible around the mid of last year. We probably should have considered that the push from, for example, fiscal expansion in the US might have generated high demand pressures, and that was missed. Now we see the risk again of a second bottleneck if you look at the zero COVID policy effects on the part of China in the transport of intermediate goods, and which is really causing another constraint on the supply. But as far as the oil and gas price increases, well, we consider them to be temporary.
Okay.
Is it a mistake? Well, basically, we did not predict the war. Should we have predicted it? I don't know. We certainly do not have. We should organize ourselves better, also in trying to understand the geopolitics of things. But clearly, we didn't think that would take place.
Well, and of course, you're keeping all of that in mind, you say, going into the future. Mr. Visco, thank you so much for your time, for your time here at this G7. And of course, enjoy the rest of the day. I know the talks continue here, and we wait for the final press conference. Thank you so much for joining us.
It's a pleasure.
Francine?
Maria, thank you so much. Our European correspondent with Governor Visco of Banca d'Italia saying that we must avoid wage price spiral. He's also saying that it's not obvious where the interest rates will settle. July is perhaps, he believes, the right time to start rate hikes. Now, coming up, we speak to the BlackRock chair, Philip Hildebrand, on all things markets. We'll go back to that Visco interview. We'll talk about the European economy. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Now, Philip Hildebrand, the vice chair of BlackRock and former chairman of the Swiss National Bank, is still with us. And Philip, we were listening to the interview that Maria Taddeo did with Governor Visco of Banca d'Italia, where he's talking about wage spiral and the fact that that's maybe one of his main concerns, that once that starts, it's even harder to deal with inflation. Can the ECB really raise rates in this kind of environment?
I think they can. They should normalize. There's no reason why they should remain where they are today, but he also made it very clear there are no excessive demand pressures.
Yeah.
And I thought very interestingly, he said that, you know, we're not yet at pre-crisis level of activity, which again makes this point that this is a supply story. And so therefore, I believe what's going to happen is gradual normalization, plus the economy is going to slow down. We'll probably head into a recession, technically, and that should take off quite a bit of the pressure. So I think it's quite unlikely that we start to see a kind of wage demand spiral taken off.
I mean, we're close to parity, actually, euro-dollar. What does if we touch parity, how problematic is this for dollar, for the U.S.?
Financial conditions are tightening. There's no question. You're going to have higher interest rates. The economy is slowing in the U.S. I don't think it's going into recession, but it's certainly slowing. And so the combination of financial conditions, the currency in particular, rates going up, the tough talking, and the economy slowing down, I think is going to take quite a bit of that pressure out. So we should be at peak inflation at this stage and start to see that ease off.
All right, Philip, thanks so much. Phil Hildebrand stays with us. We'll talk a lot more about the UK, and maybe we'll touch on China as well. Coming up, we continue the markets conversation with the BlackRock Vice Chair, Phil Hildebrand. In the meantime, if you look at stocks, they're actually a little bit supported by what China announced this morning. So we've had a volatile week with the S&P 500 losing the most also in 2 years. That was Wednesday. Now we're seeing U.S. futures rise, European stocks rise. Again, this is after China's latest measure to bolster its economy injected a note of optimism at the end of another pretty volatile week for global markets. Next week, it's also Davos, the summer Davos. I don't know how we'll cope. We'll talk about that. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Surprise stimulus. Chinese banks cut a key loan rate by a record to boost the economy. Global stocks push higher on the unexpected reduction. No sympathy from the Fed. The Kansas City president, Esther George, says rough markets will not deter the FOMC's tightening plans. Plus, inflation anguish. The UK consumer confidence strikes the gloomiest reading since the 1970s after a surge in the cost of living. But defying the gloom, April retail sales actually unexpectedly jumped. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're also always keeping an eye, of course, on geopolitics. President Biden on his tour in Asia, just arriving in South Korea. Now, this is, of course, one of the key allies. The war in Ukraine has preoccupied much of Washington, and I have to say it's taken up most of the president's time. I guess provocations from North Korea have also intensified. China continues flexing its economic and military might, which is why this visit it's so important to show his top partners that he also wants to focus eastward and westward. So we'll see exactly what the president's message to South Korea is. This also comes amidst heightened and growing anguish over possible North Korean missile tests. Now, back to the economy and back to the markets. Stagflation, recession, and economic uncertainty are big themes that central banks around the world are grappling with. Now, here are some of the leading voices weighing in on central bank policy.
What is unavoidable is stagflation. I would take actually the approach of Andrew Bailey at the Bank of England. I would be brutally honest.
I'm afraid the one that I am going to sound, I guess, rather apocalyptic about is food.
And the Fed is finally catching up to developments on the ground.
It's been very difficult for households, obviously. Gas prices have been extremely high. Food prices are high.
It was avoidable had the Fed not stuck to its transitory inflation characterization.
Things are so uncertain in the economy right now, it's very difficult to think about trying to give guidance out into the future. Inflation is coming down. That's what we really need to see.
As inflation comes down, hopefully some of those prices will revert and they'll come down.
We're back with Philip Hildebrand, Vice Chair of BlackRock and former Chairman of the Swiss National Bank. So, Philip, it's great because you, of course, understand both worlds, the worlds of investments and the worlds of central bank. When you look at some of the concerns out there, so we had a conversation with Mohamed El Arian, who was saying, look at the Bank of England, they're so brutally transparent that actually that's the only way that central banks can operate in this kind of environment. But the UK has even a tougher job to dealing with this growth versus inflation concern than other G7 central banks.
They were the first ones to raise rates very quickly. They're also the first ones to openly acknowledge that there is a serious trade-off here. In a world shaped by supply, you know, if you raise rates aggressively, you're going to hurt the economy. You're going to have to hurt it very much in order to get inflation down. So I think that's what they're saying. I think the UK is a special case because we have underlying fragility as a result of the post-Brexit environment, which is not much talked about these days, but that's still very much part of the feature. So that makes the governor's job even more complicated.
What does it mean for fiscal policy? So again, we come out and often we talk about inflation and forget that it's 2 years of COVID, which means that a lot of the readings were off, but also we had this huge amount of stimulus that could have helped with inflation, but also, of course, helps with, large pieces of the population that really need the support.
Yeah, I think for the first time in human history, we were able to basically bridge a global pandemic or a pandemic generally by way of fiscal support in various ways. Different countries chose different ways to do it, but that's a unique thing that's never happened before in human history. We're going to have to kind of bear the cost of that with much higher debt rates, which means going forward, fiscal policy is going to be constrained. That's why there's so much focus right now on what happens on the monetary side.
Where do you see the biggest dislocation in the markets? I mean, we're talking, in the break about the bond market. Like, when you look at the move in certain parts of the bond market, like, if you put that in perspective, it's huge swings in the last 20 years.
It is. The correction is unique in history, right? So 94 is the famous bond massacre. Mm-hmm. But what we've just seen is twice the magnitude in terms of the correction. And that shows that, of course, this is a very significant paradigm shift from basically a multi-decade bond market rally, very kind of structural decline in yields, and that has now reversed. We're heading into a world of higher inflation. I think it's very likely that as we look at the next 5-6 years, we're going to have higher inflation rates than what we've had for decades. So this is a very significant change with vast implications for portfolio construction, for the bond market generally. And remember, most people have never traded bonds on the short side. I always joke at BlackRock, Larry Fink is probably the only person at the firm today who ever traded a bond on the short side, and only just in terms of the timing. So this is it's a real change in paradigm that we're witnessing.
What does that mean? That we could have huge price swings, huge, again, dislocations? Is there a worry about liquidity actually being available in parts of the market?
No, the good news, I think, the way I look at the financial markets, unlike 2007, if you kind of exclude Bitcoin and that part of the markets, the banking system as a whole, to me, looks pretty balanced. I don't see any major imbalances in the financial system outside of Bitcoin, and that's very good news. So I think the markets and the system, the financial system, certainly will be able to cope with this. The markets, of course, have to find a new equilibrium. Again, this is a major shift in the bond market, and equity markets need to figure out where are the central banks really going to end this tightening path. The rhetoric right now is very, very tough. As I said, they've gone from one end of the boat, one side of the boat on transitory, to the other side of the boat in a rush on over-tightening. It's going to take some time for things to settle.
What's your take on a possible recession? And actually, if there is a recession, we often don't define what kind of recession we could be living through.
I still think it's unlikely in the U.S. unless the Fed really decides to hammer the economy, which I believe would be a mistake because this inflation is driven by a world shaped by supply. Now, the risks of that have gone up. So I think the risks of a policy error are up. There's no question. Nonetheless, I believe a recession is unlikely in the U.S. Sadly, in Europe, it's just about inevitable.
What's your take on China? Is it an economic force for good, or is it a danger of policy mistakes?
We'll see. I think what they're grappling with is it was completely unrealistic to think that there is no trade-off between a zero-tolerance COVID policy and the economy. And the target of 5.5% was completely unrealistic, which they've now, in a sense, acknowledged by this aggressive easing step today. So I think they're going to face two choices. Either they have to depart from the zero-tolerance COVID policy, or they have to significantly stimulate the economy if they want to be anywhere near the official target, which continues to be officially at 5.5%, which in my mind is unachievable at this stage.
Philip, when you look at all the markets and actually all of our discussion, where are the havens? So I want to ask you, if you look at Swiss franc, yen, does it still fill the purpose that they used to?
Very difficult, right? These certainly the Swiss franc is a limited liquidity currency, so it has safe haven features clearly, but as you can see in this environment, it can kind of accommodate these massive shifts. And in fact, one of the things we're seeing is the kind of breakdown of normal market correlations. It's not like you're running out of equities and can run into bond markets. And so I think that's one of the things that investors are grappling with. If you want to reallocate, where do you go? And one of the features of what we're observing, and I think it's linked to this point, is that we haven't actually seen very significant liquidation in terms of flows. So clients recognize that the normal instincts of going from bonds to equities or vice versa aren't working. We're going to have a year where certainly the bond market is going to be down on the year again. We'll see about equities. So that makes it very difficult to make asset allocation shifts. As a result, we're seeing less outflows than one would have expected when you look at price movements.
We're just looking at President Biden there, who also has to grapple, I guess, with a higher dollar, which is something that we were mentioning before. It's a 6-day trip in Asia, and this is the first, of course, stopover in South Korea, strategic allies. I'm sure they'll discuss China and North Korea. Philip, when you look at, I guess, the correlation, as you were saying, between equities and bonds, will we ever go back to that more normal kind of tracking of the two?
I think eventually we will. The next 5 years, let's say, are going to be a complicated world because we have to cope with very likely a much more fragmented world. It'll still be global in some ways, but in a different way. We may have different camps. Trade is going to flow differently. We've peaked in terms of globalization since 2007. It's kind of been a sideways movement. We're going to have rebuilding of supply chains, more resilient. We have sustainability coming into this as a big cost factor. So I think it's quite likely that we're seeing for some years higher levels of inflation. Again, I think we're at peak inflation, but it'll settle at a higher level than what we've seen before. Much more fragmentation, less focus on efficiency, more on resilience. No. So I think markets have to cope with some very fundamental shifts in the way the global economy works. And on top of that, we're very likely to have geopolitical tensions going forward for some time.
Being on a Formula One track.
It is. It's difficult, and I think resilience of portfolios will be the name of the game.
All right, Philip, thank you so much, as always, for your time. Philip Hildebrand there, Vice Chair of BlackRock and former Chairman of the Swiss National Bank. Now, also, the German Finance Minister, Christian Lindner, has told Maria Bloomberg it's key to get inflation back down to 2% to reduce pressures on prices. Now, Lindner spoke exclusively to us on the sidelines of the G7 Finance Ministers meeting in Bonn, Germany.
It is inflation. In the long term, we need sustainable growth for all of our economies. We have to rehabilitate growth in a sustainable, inclusive way. It's a long-term project. We have to finance transitions to a greener economy, digitalization. We have these special challenges for mankind. But in the short term, we have to deal with rising inflation rates. This is, I think, it's key for our economies that we reach again the level of 2% inflation rates. Now we have to take tough decisions. On the one hand, the central bankers, and on the other hand, the governments with their fiscal policy measures. I'm in favor of a neutral fiscal stance. We have to maintain a stable macroeconomic environment. And I suggest to focus on the supply side of economic policies, which means not to pay subsidies and subsidies and subsidies, but improving the surrounding, the ecosystem for businesses, invest in education, research and development, to have productivity progress, and not effects on the price level, which is already very high.
So kind of your message is that inflation as it stands for you as Finance Minister of Germany is not acceptable. But
not Germany. It is for all G7 member states, all G7 countries, a key priority to fight inflation with tough decisions. But in first instance, it's a responsibility for the central banks, and then we have our approach as governments.
German Finance Minister Christian Lindner, they're speaking exclusively a little bit earlier to our Maria today on the sidelines of the G7 Finance Ministers meeting in Bonn, Germany. Now coming up, Richemont's Record, the maker of Cartier jewelry, sees the most growth sales since 1995, but the share price is significantly under pressure now. We'll be joined by the founder of Yux Net-a-Porter, Federico Marchetti, to discuss luxury market trends. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Richemont reported full-year earnings that saw operating profit for 2022 more than double compared to 2021. But the luxury maker dampened its outlook with a bearish China forecast. Well, Bloomberg's Laura Wright now has been across the results. So, Laura, what are the key takeaways?
Well, Francine, this is a China lockdown story. 40% of Richemont's store network in China remains closed. The chairman stating that operating in China in the current environment, it's like having a black tie dinner party on top of a volcano. Richemont now trading down some 9%, and we're seeing a read across with other luxury names such as LVMH and also Hermes. In terms of the division space, it was a beat on sales growth across 3 of the 4 divisions: jewelry, watches, and other. Jewelry is still the largest contributor to overall revenue, and jewelry businesses such as Cartier, Van Cleef & Arpels, they've actually benefited from LVMH's acquisition of Tiffany's because it stimulated overall demand in the market, therefore being beneficial for Richemont. There is robust demand for luxury timepiece watches, and in fact, the US is now the world's #1 importer of Swiss luxury watches, overtaking China back in October of last year. Leather and fashion comes under other brands such as Chloe and Dunhill. Strong performances there. It's interesting with online. Richemont have struggled to generate profitability with their online business, Yoox Net-a-Porter. No news on a potential tie-up with Farfetch. Reports stated Farfetch may take a minority stake in Yoox Net-a-Porter, so disappointment from the market not to hear anything on that. And a quick note, Francine, I've taken a look at sales on a normalized basis over the last decade for brands such as LVMH, Kering, and Richemont. Yeah. And what it shows us is that brands with a focus on leather and fashion, they've been able to outperform. But overall, these companies, they don't have supply chain issues. They've been able to increase prices already by 4 to 5%. Focused demand on local domestic audiences after the pandemic. But China aside, no sign that pent-up demand is diminishing in the medium term.
All right, Laura, thank you so much. Laura Wright there with some of the numbers from Richemont. Now, we're now joined by Federico Marchetti. He's founder of Yoox Net-a-Porter Group, the world's first lifestyle and e-commerce destination. He's now also chair of the Sustainable Markets Initiative Fashion Task Force. Federico, thank you so much for joining us. I have so many questions on, first of all, how difficult it is to build a kind of a global e-commerce platform, giving all of the different variations here.
Thank you, Francine. I think the point is that e-commerce is such a complex business on behind the scene that to put together different companies is not an easy task. And for example, when I did the merger with Net-a-Porter, it took many years then in terms of culture, technology, migrations. So I think it's just a very complex business to make it profitable and to make it sound together.
Federico, how is the market for fashion and luxury actually changing? I mean, this brings huge money. It's extremely popular, but you don't have the Chinese consumers anymore. You have a lot of, I guess, question marks over the Russian buyers. How do you think it will change and replace what we used to know 10 years ago?
I mean, as you know, I left the Yoox Net-a-Porter in July 21, so it's almost 1 year after a long ride of 22 years, because I founded it in 1999. And I decided to move to sustainability, fully on sustainability, which is one of my passions since 2008.
Do you miss running the company?
No, I don't miss it, especially during these times.
Sustainability is also extremely important because it's one of the I guess, least sustainable industries because of the way we do leather and things like that. What are the concrete actions that your world, the fashion and luxury world, can do to be more sustainable?
Yeah, I've been asked exactly 1 year ago by the Prince of Wales, His Royal Highness, to lead and to chair his fashion task force within the Sustainable Markets Initiative, which is a big organization that he launched in Davos that basically wants to bring the big businesses into sustainability in an accelerated way. And 1 year ago, I gave the Fashion Task Force that I'm honored to chair a couple of visions of the future of fashion. You asked me about where fashion is going. And in terms of sustainability, obviously, I'm a tech entrepreneur, so I wanted to bring technology and innovation into this task force. And the first one was a digital passport, and the second one was regenerative agriculture. And in the last 12 months, we have launched the digital passport at the G7 in Rome. And so all the brands, all the members of the task force, they are rolling out an implementation plan of a digital passport. And the second one that we have just launched is the regenerative agriculture.
And Federico, I mean, what you're very good at, because you're a businessman and you have this background, is of course getting things done. The framework is strong, but unless it's mandatory, are you concerned that actually companies will say, oh yeah, maybe I'll sign it, but I won't really do what I need to do to become more sustainable in 5 years?
No, it's a good point. I mean, as an entrepreneur, I love action and not talking. No.
Yeah.
And so, and that's why I gave two precise objectives to the task force. And the methodology, the way we work is first we get the commitment and then we do a concrete action. So on the digital passport, commitment by all the brands, and then a steering committee that is following each brand, tracking all the brands' roadmap in terms of the implementation of the digital passport. So nothing is left on the air.
Okay, so you'll come back in 6 months to tell me success, right? Or not? Because
I think so.
In 6 months, we'll know more about who signs?
Absolutely, absolutely. But they have already all of them have signed, and all of them are working. It's just a question of the timing, the implementation. And I think by the end of the year, we'll definitely see the first results.
Okay, implementation is so important. Federico, thank you so much for your time today. Federico Marchetti there, the founder of Yoox Net-a-Porter Group and chair of the Sustainable Markets Initiative Fashion Task Force, and we'll hold him, of course, to that and get him back shortly. Now, coming up, Citadel founder and chief executive Ken Griffin gives us a glimpse of his thoughts on the U.S. economy. He takes a less bearish stance on recession risk. That exclusive interview is next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Yes, a recession is inevitable. The question is when, timing-wise. And we don't think a recession is likely over the course of the next, let's call it 4 quarters for sake of the argument. We don't know what causes recessions to start. We know the ingredients that create the kindling wood that allows recession to happen, but what actually is the tipping point's often unknown.
Citadel founder and chief executive there, Ken Griffin, talking about a recession. Now, let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine, and happy Friday.
Happy Friday.
SpaceX has reportedly paid $250,000 to settle an employee's claim that she was sexually harassed by Elon Musk. According to the website Insider, the company made the payment to a flight attendant who worked as a contract employee on the SpaceX corporate jet. Musk calls the accusations utterly untrue. Now, EDF's flagship nuclear plant in the UK will cost more than expected and take longer to complete. EDF now expects the 2 reactors at the Hinkley Point C plant to cost between £25 billion and £26 billion. And that's your Bloomberg Business Flash, Francine.
Leanne, thank you so much. Happy Friday, everyone. Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta, Kaylee Lyons, Anna Edwards. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Even though the market has revalued itself, it may have to revalue more because the E part of the PE ratio is going to come down.
Financial markets have a really tough time discounting things that are likely to happen or may happen in the distant future.
Companies that can think about what their exposures are and how to hedge those and where they do have pricing flexibility or power, those are the ones that are going to survive.
What we're seeing in the markets is a rotation from growth stocks with earnings very far in the future towards stocks that are much more value stocks, earnings here in the present.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, May 20th. Our top stories today. Beijing gives the markets a boost. U.S. futures and European stocks are up after Chinese banks slash a key interest rate. Joe Biden in Asia. His first trip there as president will be dominated by talk of security and semiconductors. And more aid for Ukraine. G7 finance ministers agree on a $19 billion package of assistance for the Ukrainian government. Hours before that, the U.S. Senate gave final approval to a package worth more than $40 billion. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kaylee Lines in New York. Matt Miller is off today. And Kaylee, something certainly coming to the rescue to rescue market appetite for risk assets, or rescue us if you're long at the market at least. Yeah. And some of that coming through in the Chinese session.
Absolutely. You can thank policymakers in China for a lot of the positive sentiment we are seeing come through to end this weekend, although it could still be the 7th straight week in a row of declines on the S&P 500, the longest losing streak since 2001. So we have to keep the week in its entirety in mind here, but it is a more positive end to it, at least it looks like at this point. It was definitely a positive end to the week in Asia. You had Chinese banks cutting the 5-year loan prime rate from 4.6% to 4.45% in order to shore up the economy. The thing is, economists expected that a cut was coming, but they thought it would be in the tune of 5 to 10 basis points, and what we got was 15 basis points. So positive surprise on that front. That lifted Chinese equities by about 2%, and of course, those Chinese tech stocks, as measured by the Hang Seng Tech Index, was up nearly 5% overnight. You were seeing some of that positivity, more positivity around the China growth story, rippling through other asset classes as well, including the Chinese yuan, one of the big outperformers in Asian FX, stronger against the dollar by about 0.6%, trading right around that 668 level. And finally, iron ore, of course, benefits from better Chinese growth because it means more demand for that commodity. You saw that reflected in those futures in Singapore overnight, up a little more than 5%, trading right around $133 a ton, Greedy.
Yeah, Kaylee, that risk-on sentiment over in Asia, kind of feeling over into the United States as well. You can see futures up 1.1%. Remember, we did turn or close the day yesterday in a lower session, so you do see the S&P 500 futures rebounding just a little bit. Some of this is simply going to be a function of that volatility. The green one day, red next day, and then green again. And remember, look, this is a cross-asset dynamic, so you are seeing the 10-year yield up by about 3 basis points. So once again, yields higher, suggesting perhaps of a little bit more risk-on appetite. Here's where it gets tricky, though, because if you look at crude futures, they are down 0.5%. This is important as we talk about the global growth story, and not just whether or not we're going to hit recession, but whether or not refining capacity can actually be catch up in time to this extremely strong growth that you're seeing. And that's the dynamic that's starting to weigh on the commodity market, specifically for oil here. So we're going to keep an eye on that for you. For now, down 0.5%. And just to kind of cap it all, the risk sentiment, our classic risk sentiment indicator, Bitcoin down about 0.2%. A marginal move for Bitcoin. Let's see if that turns around as we get some more green on the screen today, Anna.
Yeah, what does that move lower in Bitcoin tell us in terms of sentiment then, Kriti, given this is the sentiment we have in Europe right now, unashamedly positive. A little bit of this is catch up with the US at the latter part of the trading day yesterday. Some of it is reflecting the news out of China, but something has turned the market mood around for this Friday, and we are moving higher. The CAC 40, the Xetra DAX, and the FTSE 100 all posting pretty strong gains. And actually, to get to Kriti's point about lower oil prices, despite that, we have some quite strong buying of energy stocks, and that is one of the things that is lifting the London market. nearly every sector is in positive territory. There is one here in Europe that is not, and that is consumer products and services, and that sector is down by 0.7%, and this is the reason why. This is Richemont, the Swiss luxury giant, the maker of jewelry and expensive watches and the like. That company down by 11.4% today. The numbers coming through, but it wasn't really the backward-looking story that spooked the market, although there were losses attached to Russia and also to war in Ukraine. But there was also the guidance they gave, the conversation that's taking place around China and what they can do there, and that quite negative coming through from the chairman this morning. Darktrace is an interesting one. This is a cybersecurity business listed in London, up by 8.4%. But really, this is a story linked to Palo Alto and that company reporting after hours. And as that stock surged after hours, so goes Darktrace here in London. The pound is up 0.1% this morning. Not a big move, but I put it in here, Kaylee, because we've had some quite conflicting signs at first glance, at least, on the UK consumer. The consumer sentiment numbers out overnight coming in the worst since 1974. So that's nearly 50 years. Consumers have not felt more negative here in the UK. On the slightly more positive side, the retail sales number showed a bit of a pickup compared to expectations, but many people putting that down to people stocking up on supermarket products, on grocery store products, instead of going out because they fear tougher times coming.
Yeah, really that focus on the consumer has been one of the primary stories of this weekend, especially after those retail results we got out of the likes of Target and Walmart. And of course, the week is not yet over. We still have to get through this Friday. So here's a look at what is ahead today. U.S. President Joe Biden is beginning a 4-day trip to South Korea and Japan. Semiconductors really front of the agenda as he visits Asia. Then we're still going to get more earnings out. Deere will be reporting its second quarter results before the market open. And finally, at 10 a.m. New York time, there is a House hearing on building a workforce to navigate the electric vehicle future. Anna?
In China, then, let's get to that top story then, Kaylee, as we've both been mentioning it this morning. Banks have taken a step aimed at boosting the ailing economy. They cut a key interest rate for long-term loans by a record amount. Let's get more with Bloomberg's Tom McKenzie. And Tom, this does seem to have lifted sentiment, doesn't it? Certainly through the Asia session and to some extent here in Europe as well. It is perhaps well designed, according to our colleagues on the Markets Live blog, but is it going to have a lasting impact, given it's trying to counter another policy, which of course is the COVID zero?
Well, these two policies are in conflict, and it's clear that's the right way to frame it, certainly. The context, the details around this, and Katie was talking about the 15 basis point cut, which of course came in below the estimates, so a bigger cut and a record cut since 2019 when they reformed this. And the significance is that this goes towards those 5-year loans, which are primarily used for mortgages. So it's targeted at the real estate sector, which of course has faced the dual impacts of the regulatory squeeze, but as you say, the restrictions that we're seeing in cities like Shanghai, COVID zero. So how that plays out is one that we're going to watch, but we know that loan growth has fallen quite dramatically. Fitch, by the way, just coming out in the last few minutes, saying they expect sales out of China, real estate sales, housing sales, to fall between 25% and 30% this year. And for the context, the real estate sector in China makes up about 20% of that country's GDP on some measures. Talking of GDP, interesting that Bloomberg Economics and team have come out and said they don't expect growth of more than 2% out of China this year. 2% growth out of China. Within the context, that brings us back to levels last seen in 1976. It would also mean that if the team at Bloomberg Economics are correct, you would see the US outpacing China for the first time since 1976, because they forecast the US economy growing 2.8%, China now 2%. The target for the government they've set themselves is around 5.5%. You're expecting, many economists expect them to miss that. Whether we get to 2% is another question, but that would be remarkable with political implications as well.
Bloomberg's Tom McKenzie, always fascinating. Thank you so much. Let's turn now to Bonn, Germany, where G7 finance chiefs have agreed on more than $19 billion in short-term financial aid for Ukraine. German Finance Minister Christian Lindner spoke exclusively with our very own Bloomberg's Maria Tadeo.
We are fundraising to secure the liquidity of the Ukraine government. And it appears that there will be more than 18 billion we can ways to support Ukraine in this crucial historical moment.
Maria Tadeo joins us now from the G7 finance ministers meeting. Maria, what have we learned?
Well, Kriti, I think that essentially he told us exclusively before the communique comes out in a couple hours that they will get to an agreement over the short-term funding for Ukraine. Remember, the Ukrainian government had said over the past couple weeks that they need about 5 to 7 billion on a monthly basis to be able to cover their expenses. This is hard cash for this country that has been torn by the Russian war on the government in Ukraine. Now, Christian Lindner told me that in this communique, there will be a clear pledge from the G7 to put on the table more than 18 billion euros, so about $19 billion to be able to provide this funding. And he also told me, the way I see it, the Ukrainian government is not going to have any liquidity issues over the long term. Of course, there's a question around the long term and the reconstruction of this country. But if you look at the short term, and that was the concern, the hard cash they need, he says by the end of this G7, that should be solved.
All right, Bloomberg's Maria Tadeo reporting from Bonn, Germany. Thank you so much, and great interview that you had earlier. Now let's head over to Washington. The U.S. Senate has passed an aid package for Ukraine worth more than $40 billion and sent it to President Biden for his signature. Meanwhile, Biden has offered support for Finland and Sweden's bids to join NATO. He met the Finnish president and Swedish prime minister at the White House yesterday, a day after they applied to become members.
This is about the future. It's about a revived NATO that has the tools and resources, the clarity and conviction to defend our shared values and lead the world.
Anne-Marie Horder, Bloomberg Washington correspondent, joins us now from D.C. for more. So, Anne-Marie, what's the next move for the Biden administration and the alliance more broadly?
Well, the president will send this bid and get Congress's approval on it. And then, of course, really the elephant in the room was what Turkey thinks of it. And the president didn't go there, but the Swedish prime minister and Finland's president went there, saying that they hear their concerns of other NATO members and they want to have this open dialogue with Turkey, because we do know that Turkish President Erdogan is trying to block this bid. But many NATO countries, and I was over the weekend with Secretary Blinken at the NATO foreign ministers meeting, and what you heard overwhelmingly is that all of these countries, barring Turkey, really support the bid from these Nordic countries. And President Biden said yesterday that they really have stepped up to meet the NATO requirements and then some. So quite a historic day for the president, because a few hours later he got another win when the Senate approved with overwhelmingly bipartisan support that $40 billion aid package, which means fresh military aid, humanitarian aid, economic aid, and also money to replenish military stocks in the United States will be granted for their use.
He's had a busy time, hasn't he, President Biden? Because now he's over in Asia, Anne-Marie. He's in South Korea. I know that semiconductors and security are going to be a focus. Tell us what that means.
So security on the first part, of course, in the region because of the provocations from North Korea. And if you talk to officials, they are quite concerned that potentially North Korea would actually do some sort of test while the president was in the region. But then, of course, he's going to look at the security of shoring up supply chains. And that is when he's going to be touring just later this afternoon in south of Seoul in a massive complex that Samsung runs for chips. And actually, this complex might mirror what Samsung is building in the United States and Texas. And this is really an opportunity for the president to also point the finger at Congress to get over the finish line, something they've been debating for months, which is a broad-based China competition package, which has some $50 billion to semiconductor research.
All right, thanks as always to Bloomberg's Anne-Marie Horder down in Washington, D.C. for us. Now, one more story we are following today. SpaceX reportedly paid $250,000 to settle an employee's claim that she was sexually harassed by Elon Musk. That's according to the online news site Insider. Musk, in a series of tweets, called the accusations utterly untrue. He said that, quote, "The attacks against me should be viewed through a political lens, but that nothing will deter me from fighting for your right to free speech." And of course, that right to free speech is something that he has evoked quite often as he pursues that $44 billion deal for Twitter, although he only really wants to pursue it if bots make up less than 5% of users. And of course, we continue to see Twitter trading under that offer price of $54.20 a share. Interestingly, though, while it does remain below that level, it is actually moving higher in early hours this morning, up about 2.7%. So we're trading around $38.30. And of course, Tesla, Elon Musk's other company, up 2.7% or so in early hours, taking part in a broader rebound we are seeing in some of those high multiple technology stocks this morning. Another stock that is moving higher in a big way is Palo Alto Networks. Anna actually actually made brief mention of this one. It is a network security firewall company. It reported earnings that topped estimates. Analysts really positive on the billings growth that this company is seeing. That stock up 11% right now in early hours, but absolutely plunging in the early trade. Ross Stores. Yes, another retailer cutting its profit outlook because of the inflationary pressures these companies in this industry is facing, changing consumer behavior possibly in the face of higher prices. So Ross Stores down 27.5% in early hours this morning, Anna.
Yeah, fast-changing story when it comes to the global consumer. Well, the US and the UK certainly in focus this week, and we have learned a lot about both. We will no doubt talk about that and other subjects with Mike Bell, JP Morgan Asset Management Global Market Strategist for EMEA. And we will also be talking to Kamakshia Trivedi, Goldman Sachs co-head of Global Foreign Exchange, Interest Rates and Emerging Markets Strategy Research. Lots to discuss with him coming up shortly, plus The View from Citadel. Billionaire Ken Griffin spoke exclusively to Bloomberg in a wide-ranging interview, from the market sell-off to the end of Melvin Capital. The hedge fund is facing irate investors, and Griffin, who helped prop up the fund last year, says he's not going to second-guess Gabe Plotkin's decision.
Gabe was certainly an iconic investor over his career. Over his career, he did an incredible job for his investors. Kudos to him. We all react to adversity in different ways. He went through a really tough run. He chose a decision that worked for him.
About what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Earnings season continues.
There's so much nervousness in the market right now.
This market punches you in the face.
Bloomberg is fastest with the numbers and analysis.
Big numbers from Disney.
It just slammed expectations.
Bloomberg, the fastest numbers and analysis you trust.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kaylee Lyons in New York and Anna Edwards in London. Matt Miller is off today. If Matt Miller was here, he would give you some sort of rant about a drawdown, trust me. And this is why I chose this particular chart, because I want to look at the S&P 500 drawdown. Matt would point out that a drawdown traditionally looks at a peak to a trough, but how do you know when the trough actually is if you're right in the middle of it? And that's really what this chart shows you here. For our radio audience, stick with me. We are dropping peak to trough 17.4%. 4%. We haven't quite hit that 20% bear market yet. And you'll see the last time that we did goes all the way back to March of 2020. The question here is, now that you're starting to see perhaps a little bit more green on the screen in the last couple of days, flip-flopping from the red, does that signal the market is bottoming out? Let's ask an expert. Ksenia Galushko, Bloomberg's equities team leader, joins us now. Ksenia, let me put that question to you. Are these the signs of the bottom of this potential bear market?
It depends on the signs that you're looking at. So if we look at technical indicators like market breadth, and if we're looking at the 200-week moving average, they do signal that there is more downside from here for U.S. equities, which would bring us to a bear market, 20% a drop from the top in January. At the same time, the valuations are looking quite positive. So the S&P 500 P levels are now trading below the 10-year average. So the froth has come down. The S&P 500 valuations are now the lowest since April 2020. So it could signal buying levels from here. So it depends on which indicators you're looking at the end of the day.
It depends on the indicators. Talk us through where money is flowing to and where it is flowing out of, Ksenia. I know you've been doing some research on money flowing out of various asset classes. I spoke to a guest earlier who was so spooked, he was talking a lot about cash.
Yeah, it's really fascinating. So we got the latest Bank of America and ETFR global data today and the flows. And well, everything is exiting everything. It's really crazy. So both cash funds and bond funds and equity funds and gold funds, also massive outflows in the past week. And actually, some of the few havens that we saw that investors actually put money in were U.S. equity funds, surprisingly speaking, considering the sell-off that we've been seeing, and also U.S. treasuries. So the market dynamics are really quite interesting. It shows that investors are quite spooked. They are fleeing most asset classes, but at the same time, we are starting to see some buying. So for example, in U.S. equities, we saw inflows into real estate and utilities. So more defensive sectors are dominating. And then outflows dominated such value and cyclical sectors as energy, mining, tech continued to see outflows because we've seen this big rout in tech and growth stocks in general. So it's really fascinating numbers.
Yeah, interesting to see those defensives doing well then. Thank you very much, Ksenia. Bloomberg's Ksenia Galushko with us on the markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Kriti Gupta in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Bloomberg's learned that President Biden is considering a meeting with Saudi Arabia's Mohammed bin Salman as soon as next month. That would mark a shift for the president, who has avoided contact with the Crown Prince over the murder of journalist Jamal Khashoggi. PIMCO and BlackRock are among the firms set to start debt talks with Sri Lanka soon. Bloomberg's learned that AllianceBernstein, T. Rowe Price, and Wellington are also among the members of a creditors group. Sri Lanka fell into default this week for the first time in its history. An economic meltdown has led to protests and a political crisis. By one account, the world only has 10 weeks' worth of wheat consumption in reserve, the lowest level since the 2008 financial crisis. That's according to agriculture analysis firm Grow Intelligence. Other estimates aren't as dire, but high crop prices are putting millions at risk while grain supplies fall. And U.S. stock traders are bracing themselves. Today is the monthly expiration of options tied to equities and ETFs. It's an event that is notorious for stirring up volatility. Traders will close old positions for an estimated $1.9 trillion of derivatives while rolling out new exposures. All of this with the S&P 500 on the brink of a bear market. Just what we needed to end a week like this one, Anna.
Absolutely. I was reading earlier, our piece on this said, fasten your seatbelts. I'm not sure we needed that this week, as you say, Kaylee. We feel like we've been doing that all week. It's been a volatile ride. Coming up on the program, we will talk about these markets, where we've been and where we're going. Mike Bell, JP Morgan Asset Management Global Market Strategist, joins us shortly. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las monitorizaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Beijing gives the markets a boost. US futures and European stocks are up after Chinese banks slash a key interest rate. China is trying to counter weak loan demand caused by a property slump and COVID lockdowns. Joe Biden is in Asia. His first trip there as president will be dominated by talk of security and semiconductors. His first stop is South Korea. There's speculation that North Korea may conduct its first nuclear test since 2017 while the president is in the region. And more aid for Ukraine. G7 finance ministers agree on $19 billion in assistance for the Ukrainian government. Hours before that, the US Senate gave final approval to a package worth more than $40 billion. I'm Anna Edwards in London with Chrissy Gupta and Kaylee Lines in New York. Matt Miller is off today. And Chrissy, US markets, are they getting a boost from the Chinese sentiment, that crucial or what seemed by some as crucial, at least to short-term market sentiment cut to some interest rates we got in China? Is that boosting US futures, or does its impact expire with European stocks?
Well, I think you're right in that the initial move is coming from China. But remember, we did close in the red yesterday. So some of this is going to be that natural rebound just in terms of this volatile market. I also want to keep in mind here that you are going to see this big move in futures or potentially the stock market later today, because after all, it is options expiration day. So this green on the screen that you're seeing, 1.2% higher in S&P futures, anything can happen at the open. Remember, 9:30, 4 p.m. New York time. Those are going to be windows of liquidity for people to kind of come in and really shake out their position. So once again, the green on the screen, it may not last, Anna, but to your point, you are seeing a little bit of a risk on sentiment. Let's call it coming from Asia, for example. 10-year yield also getting a little bit higher here, 3 basis points, 286 on the 10-year yield. Here's where it gets tricky, though. The New York crude future down 0.5%, still hovering about a 111 handle, but still a little bit of a risk-off sentiment as we talk about the growth picture really happening in the background. Bitcoin as well down 0.3%, but once again, in a volatility adjusted kind of dynamic, that's actually not that much of a move. So we're going to keep an eye on that in terms of what's coming next for risk sentiment overall, Kaylee.
Yeah, still trading around that 30,000 level, which is essentially where we've been trading for the better part of the last 2 weeks. So pretty range bound on Bitcoin at the moment. Now, of course, as Kriti said, futures are positive. It is a move led by technology stocks in particular. We're seeing some of those largest cap tech names outperforming in pre-market trading. The likes of NVIDIA up 3%, Microsoft up about 2%. Very different story, though, as we have seen all week for some of the retailers. Ross, the latest one to come out and cut its profit outlook, dealing with these inflationary forces and an American consumer that is spending more on gas, spending more on food, basic necessities, and that is impacting discretionary spending and their tolerance for higher prices. Creates an issue for retailers trying to exercise pricing power and pass on the higher input costs they are facing. So Ross is down about 28%, and even TJX, which actually lifted its margin guidance yesterday and was a little bit higher on the back of that, is falling in sympathy, down about 3%. Maybe investors having some questions as to how much pricing power they realistically are going to be able to exercise in a macroeconomic environment like this one, Anna.
Yeah, let's have a look at the European equity market then. A picture here, Kaylee, and we've got European stocks moving higher by 1.5%. The stock 600 then being lifted a little by that more positive message through from China, with everything we've already said about COVID zero policy, etc. This is the share price of Richemont, because most sectors in Europe are in positive territory following that lead, but there is one, and that is consumer products, that is actually falling, and it's the luxury side of that that's really being hit hard today. And this is the Swiss heavyweight Richemont that trades down by 12.4%. Yes, there were some hits to the numbers that they reported from Ukraine and also from China. They've got a number of stores still closed in China, of course, but it was the guidance they were giving that really weighed on the markets and what they're saying about what they can and can't do over in the Chinese market. Dark Trace, we've talked about this one a little bit. Kaylee mentioned the Palo Alto numbers earlier on, and we got a positive surprise after hours from that cybersecurity business, and that is lifting similar companies in similar spaces here in Europe, and Dark Trace in London is one of those. Sticking with London, the pound is fairly flat right now, as we've got mixed data coming through on the UK consumer, and we've learned a lot about the consumer in the UK and in the United States this week. The UK story today, the weakest sentiment picture from UK consumers since 1974. That is nearly 50 years. But on the other hand, the retail sales number picked up a little. But economists certainly emphasizing the former and suggesting that times get tough here, Kaylee.
All right, Anna. Well, of course, we also had a pretty big high-profile conversation with one man yesterday, Citadel CEO Ken Griffin. Francine Lacqua spoke with him about the odds of a recession, and he says one is coming, but it's not necessarily imminent. The billionaire spoke to us yesterday.
Yes, a recession is inevitable. The question is when, timing-wise. And we don't think a recession is likely over the course of the next, let's call it 4 quarters for sake of the argument. We don't know what causes recessions to start. We know the ingredients that create the kindling wood that allows recession to happen, but what actually is the tipping point's often unknown.
Joining us now is Mike Bell, JP Morgan Asset Management Global Market Strategist for EMEA. Mike, great to see you. Obviously, this is a market that now seems dominated by the narrative of a growth scare and the odds of a recession. What have we priced in at this point?
I would say that most markets globally are probably pricing in something like a 50% probability of a recession now. I mean, if you think the average recession probably sees stocks down somewhere in the region of 20 to 30%, and markets are now pricing in, most markets are down about 15% year to date. So I would say that, you know, most markets are priced in at least a 50% probability of a recession. And that's probably about right, given where you see consumer confidence, particularly in Europe and the UK. So the risk from here is two-way. If that recession actually happens, then stocks could potentially fall another 10 to 15% from where we are today. If we avoid recession, perhaps on the back of significant further fiscal stimulus in somewhere like the UK or Europe, then stocks could rally from here.
And what did you take away, Mike? Good morning to you. What did you take away from all that we've learned this week about the global consumer? I say global, I suppose I'm thinking mostly about the US and the UK. We've had data on both fronts and reason to worry on both fronts, do you think?
Yeah, I think that's right. I think that the consumer's under pressure. I think more so in the UK and Europe because they're dealing with the much higher energy bills than is the case in the US. Obviously, in the US, they've got higher oil prices, but they're not seeing the same extent of heating and electricity bills going up. The other thing is we see in the US actually a bit more resilience, I think, because household savings there we think are higher based on our data of the people who bank with us in the US. We can see they're still sitting on quite a lot of savings compared with pre-pandemic. Whereas I think in the UK and Europe, those savings are probably lower because we didn't get the stimulus checks and the people who were furloughed weren't getting quite as generous benefits as the people who were unemployed in the US were during the pandemic. So I think the UK and Europe is more vulnerable. You just look at consumer confidence in the Eurozone and the UK, it's extremely weak. So I think that's why there is that approximately 50% probability of a recession that the market's pricing. I think that's about right. But, it may not happen if governments step in with significant further fiscal stimulus, in which case you could see equities rallying. So I think it's a difficult time at the moment in markets because you've got two-way risk. And so for us, it makes sense to be neutral.
What are you assuming on the fiscal side, Mike? Because there are debates across various parts of Europe talking about fiscal, but some of them are couched in the language that says, well, if we spend too much fiscally, then that starts to play into the inflation push. And even the German finance minister talking about things should be fairly neutral or balanced on the fiscal side.
Yeah, I think in the UK, I think we are going to get more fiscal. It seems highly likely. The kind of political imperative to deliver some more fiscal stimulus seems pretty high. The question really in my mind is it going to be enough? So I think we will see more fiscal stimulus, but with energy bills set to ratchet significantly higher in October, are we going to see moderate further fiscal stimulus or are we going to see really a significant amount that enables particularly the lower half of the income distribution to deal with this squeeze that they're seeing at the moment. And the other thing is what's going to happen to wages, particularly public sector wages. Are we going to see a significant increase in public sector wage growth, which will help them deal with this cost of living squeeze, or not? And ultimately, whether we end up getting a recession, a lot of it's going to come down to what the chancellors in the UK and Europe end up doing over the coming months.
Mike, I feel like the no-brainer trade in this inflationary environment in the face of very hawkish Federal Reserve is to sell bonds, especially in the U.S. Treasury market. But I have to ask, in the face of this major wall of worry, recession odds, war in Ukraine, you name it, is there a bull case to buy Treasuries?
I think there is, yeah. I mean, I remember coming on Bloomberg back on Valentine's Day in February and saying that it was time to get stocks sort of back down to neutral on the Ukraine risk. The difference between today and then is that Treasury yields and indeed gilt yields have moved significantly higher since then. So I actually think that now I would stick with a neutral positioning on stocks, given the two-way risk and all the uncertainty out there. But I do think it makes sense to, at the very least, be significantly reducing the size of one's underweight positions in duration, given that there's a lot more priced in terms of rate hiking, both in the US and in the UK. And that if we do get that recession risk, then one would expect bond yields to come down, and it's starting to provide a bit more of a hedge to that.
Mike, thanks so much. Thanks for joining us. Mike Bell of JP Morgan Asset Management. Thank you very much for being with us. When we come back, we will talk about what's going on in FX markets and emerging markets. We'll be talking to Kamakshia Trivedi, Goldman Sachs co-head of Global FX, interest rates in emerging markets. We'll get to that conversation next. This is Bloomberg.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kaylee Lyons in New York and Anna Edwards in London. Matt Miller is off today. We've been talking a lot about the equity sell-off. Let's talk about the bond sell-off here, which seems to be in reverse in the last couple of, I want to say the last couple of days, but arguably I want to say the last 10 days. One of the big questions, though, is if you're starting to see a stronger dollar and yields coming down, that seems to be a disconnect. And that's really what this chart is showing. For our radio audience, stick with me here. You are seeing in this inflationary environment a very hawkish Federal Reserve, yields higher, dollar higher. It means that the interest rate differential differentials is moving the dollar story as opposed to the haven bid that we've come to know as so associated with the dollar lately. But then you saw this little bit of a divergence. Now yields lower, dollar weakening just a hair. So the question is, which direction is the right direction? Let's ask that to a true expert. Joining us now is Kamakshya Trivedi, Goldman Sachs co-head of Global Foreign Exchange Interest Rates and Emerging Market Strategy Research. Really covers the gambit there. Kamakshya, let me put this question to you. Is this the right direction for both yields and the dollar to go to? And if not, is that divergence justified?
Look, I think the key issue here is how close we are to a peak in inflation. I think that is going to be a key determinant of where yields go in the near term, but also where the dollar goes to some extent. And I think that our expectation is that at least in the US, we are getting close, the right sort of ballpark of the financial conditions tightening that is needed, and inflation, core inflation, might be peaking around now. We know that process is messy. You can have months where things are up or down, but by and large, we think we are close to that point. If that is correct, I think it does have implications for yields. Obviously, I think it makes it much harder to be short U.S. rates, given that you are at that peak. For the dollar, that's also important, but for the dollar to really turn down convincingly, you also need the rest of the world to pick up. You also need a sort of better story in other non-dollar currencies. You're getting some of that if the bounce in China continues, if we see some recovery in the data there, if you don't see fresh negative shocks in the euro area. I think that's really the recipe for the dollar to turn down convincingly.
Okay, so what about unnatural forces that may turn down the dollar? There has been at least a conversation happening about a hypothetical scenario in which you see something akin to a 1980s like Plaza Accord style, where all these countries get together and agree essentially to manipulate the dollar. What is the likelihood you put around something like that happening today?
Well, that kind of conversation comes up periodically when you see, big moves in the dollar, over time, and we have seen a pretty big move in the dollar. The dollar looks pretty overvalued to us across a whole range of currencies. But one important difference is just given how high US inflation is right now, to some extent, a stronger dollar is part of the mix that is required to bring that inflation process down. So, at some level, what is going on in markets, the combination of a strong dollar, wider credit spreads, weaker equities, and higher rates, that is how tightening is meant to work, and that is how inflation is going to come down. So I don't think you'll be seeing a huge amount of pressure or push from the U.S. side to kind of arrest this move too rapidly.
Kamakshya, it's Anna in London. You mentioned how you needed the rest of the world then to step up if the dollar was going to step back. Where does that leave European currencies? I guess I'm thinking in particular, firstly, about the euro. Is a hike in July, is that enough for the euro to put a floor under recent losses?
I think it's probably enough to, keep it roughly stable. I mean, I think that, we expect euro to trade around the 105 type level in 3 months' time. That's our sort of forecast. We think that that's sort of the start of a hiking cycle, and especially getting above that zero level is going to be an important milestone for the euro itself. I think where you can see, real divergence to some extent is versus the UK, versus the pound. I think, the UK has some of the same issues that a lot of global central banks are facing, high inflation, pressure on activity. But the Bank of England's messages have been more attuned towards kind of supporting the growth side of the mandate than the higher inflation part of the mandate, which is effectively, resulting in a weaker currency. So that's a place where we expect more weakness in pound, both versus the euro and versus the dollar.
Kamakshya, you mentioned China and the yuan a few minutes ago. I want to come back to that story because, of course, we saw that 5-year loan prime rate cut, a record cut to that rate overnight. Clearly, Beijing trying to shore up support for the Chinese economy. How much further do they have to go to support the economy and, by extension, the yuan as well?
I think it's important that they are taking measures to support or stimulate the economy. The monetary measures we've seen, and in terms of the rate cut, they've taken measures on the property and the mortgage side in recent days. But I think really the most important measure that can be taken to support the economy and that will have the biggest impact on Chinese assets, the yuan, but also more importantly, the stocks and local assets, is whether they can get COVID under control. It's very hard to stimulate the economy through monetary measures, through spending measures. You saw the very bad credit data that you got. If people are essentially unable to go out and do things or spend or do the infrastructure spending that they want. So I think first and foremost, we need to see COVID under control. If that happens, like almost every other episode of COVID shutdowns that we've seen across the world, I think you'll see a pretty meaningful bounce in the short term in the demand side of things. And I think the measures they're taking on the monetary side will help. But I think the single most important stimulatory measure they can take is get COVID under control.
Kamakshia, thank you very much. Kamakshia Trivedi of Goldman Sachs, thank you for joining us. Coming up in the next hour, more on currencies. Jane Foley, Rabobank's head of FX strategy, she will be picking up that conversation. 6 a.m. in New York, 11 a.m. in London. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Kruti Gupta in New York and Anna Edwards in London. Also joining us now, Tom Keene, co-anchor of Bloomberg Surveillance, joining us before he jets off to Davos later on this afternoon. Tom, what's on your mind ahead of that trip?
Well, we got two things. The markets are on our mind, and we're seeing a recovery in the markets. John Fear and I will dive into that with Lisa. I think the thing to really watch here is the linkages between the bond market and the stock market on this Friday. The VIX in 28.65 gets my attention. The chart is the first chart at Davos, and I'll be honest, this has crept up on me in that there could have been 3 or 4 charts, but there is no other story is the elite meet to greet in Happy Valley than food prices. This is inflation-adjusted UN food back a good 20 years, and we have launched higher big time. Wheat, U.S. wheat is up 48%. You know, it's just a rough number. But rice is what I'm really watching. And just in the last week, rice, so dominant in Asia, has finally started moving up.
Yeah. Tell us, Tom, a little about the Davos coverage. If food is the focus, I know that the Bank of England governor recently described it as potentially apocalyptic, what we're seeing on food prices.
Yeah, I don't know if it's I can't pronounce it, Ann. I'll let you do it. You know, I didn't get the fine British education. But what I know is my expert on this is Eric Martin, who covers the International Monetary Fund for us. And he's focused on Egypt as a proxy. And, of course, all of that, Anna, alludes back to the Arab Spring of over 10 years ago now, I believe, and what started in Tunisia. So wheat really, really matters, obviously off of Ukraine, but what's to watch? The pros watch rice. Chicago rice is a proxy, and Thailand jasmine is a proxy. That's what I'll be watching on the trip to Davos.
All right, well, we will all be watching you over the next 3 hours. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. And of course, we'll be watching the coverage out of Davos as well. As for what else we are watching on this Friday, I will be watching the earnings continuing to roll out. The one I have my eye on today is Deere, of course, the big industrial bellwether company, agricultural equipment. It has been benefiting in a big way as of late by those elevated crop prices that Tom was alluding to. Of course, that's been amplified by Russia's invasion of Ukraine. That leads to strong demand for farm and construction equipment. My question really is going to be, how much are they dealing with the same forces on inflation, on potentially a demand destruction environment in the face of higher prices? What kind of commentary do we get around that? Because as I say, this is a big bellwether company, so definitely something to watch out for, Creepy.
Yeah, Kaylee, not just a bellwether company for the United States, but for China as well. Remember, China makes up a good chunk of their earnings as well. But that brings me to what I'm watching. President Biden in Asia for a twofold story. One part of it is going to be those chip shortages, really addressing the concerns, bolstering up the alliances when it comes to South Korea and some of the other supply chains that extend into Asia. The other part of it is going to be really strengthening the Indo-Pacific trade deal, especially as we see China using their economic prowess against some of these major companies. That growing influence, what does that mean for the United States, Anna?
I'm going to be tuning in for a conversation a little bit later on surveillance. Kwasi Kwarteng, who is the UK Business and Energy Secretary, he's going to be speaking on Bloomberg, and this in the context of some data we've had out this week on the labour market, really tight in the UK, inflation running at levels we haven't seen since the early 1980s, at 9% UK inflation right now. Consumer confidence coming in overnight at the lowest in nearly 50 years. The consumer has not felt this gloomy. You have to go back to 1974 to find a time when this happened. And it's interesting when you break this down by age, it is the older age groups who maybe feel they can do the least to protect themselves from this inflation, Kaylee, who are feeling the pressure the most. Our colleague Dan Curtis producing good charts on that front. But Kaylee, we've learned so much this week about the consumer on both sides of the Atlantic.
Absolutely. That has been highlighted by retail earnings, not just from the likes of Target and Walmart, but even Ross Stores overnight. A lot of retailers cutting their profit outlook. It has a question on the health of the consumer and the pricing power that they face. Of course, that wraps it up for Early Edition with Creedy, Anna, and myself. Surveillance is ahead with Tom, John, and Lisa. Happy Friday, everyone. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, we have an incredibly strong economic outlook. Certainly, inflation is a concern, and I agree with that.
A recession is at least a 50-50 bet, given how far the Fed's likely to go. It's just that the timing is pretty far down the road.
The Fed does its thing. Sometimes it makes mistakes on the way, but generally it has pivoted successfully.
Everybody's afraid that they're going to get it wrong, and the chances are that they will get it wrong.
The near-term pain could be so severe that you just cannot look through it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures positive by a little more than 1% on the S&P. TK, we are set for a 7th straight week of losses.
Yeah, somebody just said Happy Friday to me and I growled at him, John. I think that's sort of the mood
That's every
that's
morning.
out there.
Isn't that every day?
Yes. That's every day, but this Friday, what do we know? You know, we got green on the screen, John, but the correlations here, and to start with Jane Foley this morning, is mint because foreign exchange is telling me there's still an immense amount of tension out there.
TK, there's so much to work through. Highlight of the week for you, what was it? Or rather, the low light. It's got to be retail in America.
The highlight of the week is it's over. Seriously, it has been just incredible stress. The highlight for me, John, is how Safe Haven clicked in about Wednesday. First thing I do, I come in, I look at Euro Swissy 1.029, and that's different from a week ago. It's sort of been stronger Swissy, little bit, but there's a little bit of Safe Haven feel on the growth scale.
I'll throw treasuries into that story too, Tom. Bramo yields lower last week by about 20-odd basis points. This week as well, just grinding a little bit lower again.
Particularly on the long end, what I find curious is any Fed speak that we've gotten this week has just confirmed that any weakening in the stock market is by design. It is not a fault of their plan. They are looking to this to actually tighten financial conditions, so they're not going to come in, and yet people seem to be downgrading their expectations for the Fed because of how weak the economy looks with respect to the retail sales and a couple other data points.
Lisa, it's a feature, not a bug.
Exactly.
It's an objective, a goal. We talked about Fed Speak of the Week last week. Have you got a Fed Speak of the Week this week?
Yeah, Esther George of the Kansas City Fed, she came out yesterday and she basically said, this is by design. I mean, I'm paraphrasing, obviously, but basically confirming the same point. This is not a Fed ready to commit a Fed put. This is a Fed saying, great, that is how we execute tighter financial policy.
At some point, they step back from all of this. I get it. But what we've got to work out, Lisa, is under what conditions? What do they want to see? What's the threshold for that to happen?
And honestly, we keep going back to credit, right? Can companies finance themselves? A, they don't have to. B, to the extent that they are, you are seeing some cracks start to form, but nowhere near the levels of stress that we saw in other big disruptions in the market in prior years.
Equities right now up 42 on the S&P. Let's whip through this price action for you. On the S&P 500 up by more than 1%. On the NASDAQ 100 up by 1.5%. Yields look a little something like this, higher by a couple of basis points to 286. 6 Chinese banks cutting rates. That, Lisa, seemed to put just a little bit of a floor under sentiment coming into the open this morning.
People have been waiting for this. How much could the Chinese government stimulate the economy in the face of the slowing economic trajectory? And just to put this into perspective, Bloomberg Economics expects that the Chinese economy will lag behind the U.S. economy in terms of growth and GDP so far this year and through the end for the first time going back to 1976. All right, let's talk about what we're looking at today. It's kind of a quiet day ahead of a weekend where everyone's going to be heading to Davos and trying to figure out how to position for the week ahead. Deere is planning to report earnings, which I think will be really interesting in light of food prices climbing to the highest ever. And not only this, but people really needing to farm more. They're expecting record profits. How can we really see that at a time of shrinking margins? Today, the G7 meetings wrap up in Germany. They are poised to agree on a $19 billion package of aid to Ukraine to keep the country operational during this conflict. How much do they also talk about other fiscal support? I mean, honestly, at what point is Europe the leader in fiscal stimulus, which is so ironic considering all of the austerity programs of Europe over the past few decades. And today, President Biden heading to Seoul in South Korea. He is going to be touring the Samsung factory. I'm very curious, John, what they say about possibly shoring up some of the supply chains, also chips.
The other story that I don't think has been talked about enough this morning, Lisa, the potential for a meeting with the Saudi Crown Prince, Mohammed bin Salman, and the President of the United States, and reporting from Washington from our team suggesting that could happen at some point in the near term.
And frankly, what is the political fallout from that? Right now, the U.S. needs more oil, not actually oil as much as gasoline. How much are they going to turn to the Middle East to shore that up versus try to talk about domestic production?
Looking forward to catching up with Anne-Marie about that story a little bit later this morning. That is important, TK. That is really important.
Well, there's a backstory here for our international audience, John, and it folds into the death of the gentleman from the Washington Post, Mr. Khashoggi. So in Washington, this is a particularly sensitive issue. I think it has a different tinge, a different tone in Washington than normal diplomatic discussion.
AMH coming up in about 10 minutes' time. Joining us now is Jane Foley, the head of FX strategy at Rabobank. Jane, what a week. Let's start with this question. Are rate hikes from the ECB, from the Bank of England, is that currency positive or currency negative in this market regime?
You know, this is what the market's trying to get to grips with. And this is really highlighted this week, particularly for the Bank of England and the data, because at the start of the week, we had a really tight labour market data. And, you know, that raised the question of, well, you know, is the labour market here more resilient to interest rate hikes? Bear in mind, we've already had 4 consecutive hikes from the Bank of England, and yet the labour market is still tightening. And so that led some commentators to the view, well, look, the Bank of England is going to have to do more then in order to create that loosening in the economy to try and bring demand down. And yet now we have consumer confidence data this morning at its lowest levels, its weakest level since around about 1974. And of course that highlights the cost of living issues that we have, the cost of living crisis in the UK. And that again, and we've talked about this before, it's difficult perhaps to reconcile this really tight labour market, too much demand on one hand, with the fact that there is this cost of living crisis and many people are really feeling the pain of higher energy and food prices. So what does the bank do? And that's what we've got to try and conclude over the next few months.
Jane, you have been world-class on avoiding FX hysteria. There's a modest hysteria over a repeat Plaza Accord, and those levels are out, depending on who you talk to, way out. Euro 90, week euro. Yen 135, 140, 150, week yen. Do you have any framework where those two currencies would weaken and the dollar would mega strengthen?
Well, you know, the first thing I would say, I'd come back to Lisa's comments at the start of the program. The Fed is tightening interest rates, and that means equities are likely to go down as they have been, and the dollar is likely to go up. And that's the reality of a central bank tightening liquidity into the crisis. So I find it very difficult to understand, you know, calls like, oh, the Fed or the central banks have got to get together and soften the dollar to help emerging markets, etc. It doesn't make sense to me. We're going to have a stronger dollar in an environment where the Fed is tightening interest rates, and when there's generally this risk of appeal, and that's related to first of all, maybe fears about the US economy next year, but also the possibility that Europe could be in recession if there is an oil embargo on Russia in Europe, and also this slowing China story. And that's really significant as part of this risk-off environment. So I think the dollar is strong. Now, can the yen pick up? Well, we've seen some safe haven going back into the yen over the last week, similar with the Swiss franc. That, I think, was on the back of better than expected current account data for Japan last week. So for 2 months in a row, we've had 2 current account surpluses. It had appeared for a while that with energy prices, with commodity prices so strong, that would erode the ability of Japan to hold a current account surplus and therefore dampen the yen's safe haven appeal. But that's coming back to some extent. But I still think the dollar is going to be king in this sort of environment.
Well, but how much more can it continue to be even bigger king? In other words, how much of these gains basically been baked in at a time when the narrative that you basically just put out is basically the widely accepted one, and you're starting to get more pushback from the likes of George Saravelos reconfirming this morning his bullish call on the euro versus the dollar, because this is all baked in, and now the only surprises could really come to the positive side from Europe.
I'm not so sure that is the case. And to be honest, I think we could be having this conversation since December. In fact, I have been having this conversation to December. Oh, all of the news is baked into the price of dollar. And at every turn, we've either got a more hawkish Fed and then more recently, more negative news about the global economy. And that's why I think China is a large part of the answers to this. So, for instance, we had more cases overnight in Beijing of community spread of COVID. And that dashes the trend of the last 4 days that there were no community spreads, and that of course had been raising expectations about a loosening of restrictions. If we get more community spread, then that is going to dampen expectations about Chinese growth even more. And actually our view for Europe is that there will be a recession at the end of this year or early next year, and that's because our house view now is that there will be an embargo on energy, and that means a recession for Europe is unavoidable. So I don't think that everything is yet baked into the price. I think China holds a lot of the problems. If growth there worsens, I think the dollar will firm on safe haven appeal, and also for Europe, I think that there are more risks for growth in that direction too.
Jane, I've got to squeeze this in. Recession year end in Europe, is that with rate hikes or without rate hikes? And if it's baked in, do they really want to be hiking into that?
Well, I think the reality is that the window of opportunity for interest rate hikes from the ECB is probably going to be very, very narrow. More and more people from the ECB have been talking about a July move. I think that's coming. To a certain extent, I think there's some jawbone in there to try and prop up the value of the euro, because obviously a weaker euro is going to make the inflationary issues worse. So a little bit of jawbone in, a little bit of interest rate hiking, but I think by the end of the year, I think the growth conditions could be too poor for them, assuming, of course, that there is this embargo. And that, of course, remains up there. We haven't had a decision on that yet.
What a messy situation. Jane, thank you. Jane Foley there of Rabobank. Euro dollar just short of 106 at 105.94. I think the surprise of the week for a lot of people, what spooked many people, including Seema Shah of Principal Investors, who I caught up with yesterday, Tom, is that we thought this story was really well understood. We've been talking about it for months and months and months. Inflation, what it would mean for margins. And then Target came out. And you start to realize that even if something is talked about a lot, even if you believe that it's very well understood, it does not mean it's very well priced.
Well, it's a pricing to it. It's the time continuum of it, John, and it's also the conflation of price analysis with real economy analysis. Target ran into the real economy.
Equity futures right now up 44. It's a bounce back. We're up by more than 1 percentage point. In the US, in the bond market, yields higher by 3 basis points on a 10-year, 286.77. Rounding out another volatile week from New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishka Gupta. Joe Biden is on his first presidential trip to Asia. The president will tour a semiconductor facility in South Korea today as he pushes to reduce reliance on China in the supply chain. Later on the trip, he'll meet with regional leaders in a bid to build support to counter security threats by China and North Korea. There's speculation that Kim Jong-un's regime may conduct its first nuclear test since 2017 whilst the president is in the region. More aid is on the way to Ukraine. Group of 7 finance ministers meeting in Germany are set to agree on more than $19 billion for Ukraine to guarantee the short-term finances of its government. That's according to Germany's finance minister. Meanwhile, the U.S. Senate has passed an aid package for Ukraine worth more than $40 billion and sent it to President Biden for his signature. And the administration said it was providing Ukraine with another $100 million in military assistance. In China, banks have taken a step aimed at boosting the ailing economy. They cut a key interest rate for long-term loans by a record amount. Lowering the 5-year loan prime rate would reduce mortgage costs. It also may help counter weak loan demand caused by a property slump and those COVID lockdowns. Boeing and NASA have launched the long-delayed Starliner space capsule. The unmanned spacecraft is headed for a rendezvous with the International Space Station. It was Boeing's 3rd launch attempt since 2019. The 2 failed attempts left Boeing perplexed, and it left SpaceX as the only American option for ferrying astronauts into space. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Continues.
There's so much nervousness in the market right now.
This market punches you in the face.
Bloomberg is fastest with the numbers and analysis.
Big numbers from Disney.
It just slammed expectations.
Bloomberg, the fastest numbers and analysis you trust.
We are fundraising to secure the liquidity of the Ukraine government. And it appears that there will be more than 18 billion we can raise to support Ukraine in this crucial historical moment.
That was Christian Lindner, the German finance minister from New York City this morning. Good morning. This is Bloomberg Surveillance. Equities heading higher for now. Futures up by a little more than 1% on the S&P. On the Nasdaq, we're positive 1.5. Equities on the week down again for a 7th straight week. You've got to go all the way back to 2001 for a weekly losing streak as long as this one right now. Yields are higher by a couple of basis points. Let's call it 3. 286.41 on a 10-year, Tom. The dollar's been weaker through much of this week. Euro dollar pushing 106 now, 105.92.
It's fascinating, John, to see right now. John, what are your thoughts here on dollar? To me, that's the great research debate of the weekend.
Starting to see some weakness creep in, Tom. And I wonder what's going to happen. My thoughts more broadly is on the other side of the pair. What happens with the euro, what happens with sterling. And we talked about this with Jane Foley of Rabobank, just 10 minutes ago. Central bank rate hikes from the Bank of England and ECB, currency positive or currency negative? Which one is it if you think Europe's going into a recession? That's a difficult call.
Yeah, well, the finance minister's meeting right now, it's going to be interesting to see. And, of course, the ECB upon us right now. Joining us now, Anne-Marie Horton joins us, and Maria Tadeo as well. Maria Tadeo and Bonn Anne-Marie Horton holding court in Washington. I know, Anne-Marie, the president channeling BTS all the way over to Seoul, Korea, and he's looking for a permission to dance. There's no question about it with Northern Asia. What is the real ask that the president is doing besides meeting with the lads of BTS?
Tom, for those that don't know who BTS is, by the way, we should note it's a very famous K-pop band, and they're actually quite good. They've gone pretty international, especially over the pandemic. But besides that, the president, this first step off the plane is a Samsung factory, and this Samsung factory is potentially going to be mirroring the one they're building in Texas, and he's going to make this a domestic story, saying this is what we need to be doing, shoring up our semiconductor supplies. The other big obvious moment of this trip, even if they don't talk about China directly, is that they're trying to have this new economic framework, something that could fill in for the TPP, which the Trump administration pulled America out of. The issue right now is, and Rahm Emanuel, the U.S. ambassador to Japan, actually said this to reporters, Asian governments don't really know what they're signing up for. Is it negotiations? Is it a framework just to start negotiations? But the point of it is to try to counter China and China's influence. And that's really the entire point of this trip.
Excuse me, Maria Tadeo, I look at this, and the president, of course, in Asia, everyone else is going to be up Happy Valley in Davos, looking at, well, the history of it all. Klaus Schwab has talked about this moment in history as a theme of the World Economic Forum. I'm calling it Davos, it's over. The holiday from history is absolutely over. What do we do in Europe this weekend and next week to readjust the path forward with the war in Ukraine?
Look,
Look, I think, Tom, we're not going to have to wait, to tomorrow or the week after. It really is about today in this G7, because all the major central bankers, finance ministers are meeting as we speak. And what we know, and the German finance minister told us this already, is that they are going to commit almost 18 billion euros to help Ukraine. That was a big concern going into this. I mean, this country could really face a situation where they don't have hard cash. They're not able to pay things on the short term. So the biggest issue was that the biggest obstacle was a short-term funding for Ukraine. So clearly there's going to be a conversation, but today this is a done deal at the G7. I think the next stage, and this is a much bigger issue, is what happens with the war and the reconstruction of this country. That is definitely the long-term picture. And also, you know, just how can you help Ukraine win the war? I think that really is the long-term conversation.
In the meantime, we are seeing the real risk of gas supplies being cut off from Russia actually come to fruition, especially as the deadline to pay in rubles does come up. And Maria, we are seeing Finland's importer Gasum Oy actually come out today and say that they're going to see Russian gas cut off. How much is Europe trying to get ahead of this? How much are we going to hear from other nations that similarly they are going to get cut off in the next few days?
Well, I think in the case of Finland, this is a country that is very well diversified. I don't think this is going to be an issue for their economy on the medium short term. They were ready for this, just like the Polish were ready for this. They were expecting also the move in anticipation. I guess we have to really reiterate this. Russia's only doing this now because of that NATO membership that they've put on the table. Now, when it comes to the bigger buyers in Europe, and that is Italy, I spoke to the central banker of Italy today. By the way, he mentioned this too, the uncertainty around the energy, and of course, Germany. These are two countries that for the time being, the Russians do not want to upset. They know it's a big buyer. They know anything they do in those two countries will have big political repercussions. But I think, yeah, they're ready for it. And they know that they have to prep, that potentially this could happen. For the time being, however, we're seeing that companies are prepared to pay in rubles, which is not exactly what the European guidance said. But you see that the real money, the real business still prevails for the time being.
And the real business, Anne-Marie, perhaps prevailing as we see the White House working toward the first meeting with Mohammed bin Salman of Saudi Arabia, as John was mentioning earlier. What's the thinking here, especially after, frankly, President Biden has called this man a pariah on the world stage and has expressed concern about human rights issues? Why is he now changing tone?
Well, I reported along with Nick Wadhams and some of our colleagues in the region back in March that the administration, due to this war, higher oil prices, was starting to move away from that standoffish approach to Mohammed bin Salman. The president came into this administration saying he's going to deal with the king, counterpart to counterpart. But everyone knows the de facto leader, the man running the country every single day, is Mohammed bin Salman. And there's been talks for a while about a potential meeting, and now there's definitely more weight on it, potentially happening, we reported, CNN reported, next month. And this is going to be very delicate, how this becomes public, in the sense that, is it just a meeting with Mohammed bin Salman? The Saudis run the GCC right now. Potentially will other partners be there, like Kuwait or Qatar? That might help in terms of some of the blowback the administration will perceive here in Washington, D.C., because the relationship between the kingdom and America was it has been deeply fraught since the killing of Jamal Khashoggi. I remember it was the Biden administration that released that report showing that this had the hands of Mohammed bin Salman on that killing, that CIA declassified report. So this is going to be a very tricky relationship. But the bottom line is, I mean, look where gasoline prices are today. Another record. I think it's $4.59. That's an average. We're not even at peak driving season. They are the only country that has spare capacity. America might have to engage with them at this point.
MH, thank you. To Maria as well. TK, that's the bottom line, isn't it? Things are getting tougher at home. Got to try and reconcile that with your goals abroad. And what's fascinating here is how we've forgotten the Pacific Rim as a president is to speak here in a bit. I mean, I look at it, John, and I just think the entire thing is na-na-na-na-na-na-na. Okay. Na-na-na, life is dynamite. Shining through Davos with a little funk and soul. Keep going, buddy. Keep going. So I'm lighted up like dynamite. Whoa, oh. BTS to meet with the president.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question. Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Live from New York City this morning. Good morning. I can't promise you there won't be more singing, so sit tight. And maybe cover your ears. There we go. Futures up by a little more than 1% on the S&P. On the Nasdaq by 1.6.
Dynamite.
It sounds really, really sad, Tom.
Thank you.
7 straight weeks of losses on the S&P 500. If we close that way, the longest weekly losing streak going all the way back 21 years, back to 2001. It has been that long. Your equity market bouncing today, but on the week still lower. If you get to the bond market, 2s, 10s and 30s, interesting that over the last couple of weeks, we've started to see bonds kick in the other way, yields lower. Yeah. Last week by about 21 basis points, this week by 5 or 6. On a 10-year on the session, again, up on the day, but down on the week, Tom, by a couple of basis points. Your 10-year, 285.87.
John, two things, and seriously, how wacko it is right now. When you put that board up on radio, folks, Handsome Pharaoh's sitting in front of a giant board, my eyes flip between the 10-year and the 30-year because I don't know where I am. I literally, the yield has been so whipsawed, I don't know which is which.
If you look at where the 30-year is right now, Tom, it's not far off where the 10-year's been this week already.
Like 3 cups of coffee.
And if you think a couple of Mondays ago, we were at 320 on 10s, and now close to 3.1% on 30s. So the curve's still pretty flat, if you look at it that way. If you look out further out into the commodity market, since early March, we're down about 9% on something like crude, down about 11% on something like copper. WTI at 112. Copper's something I'm looking out for now with China and their efforts starting to kick in. On the LME, we're up by 0.75%. Crude gets my attention because I just think the idea that we could have a meeting between the Crown Prince of Saudi Arabia, Mohammed bin Salman, and the President of the United States, off the back of our reporting, Tom, this morning, suggesting that could happen. I think that could be really, really important. Think about how long these OPEC meetings have lasted. 10 minutes, 11, 12, 13. They need to last longer. They need to do more. And that's what this president wants to see.
In the history of this, John, back to 1986, and arguably the moment where OPEC collapsed and had to grow up out of their arrogance, is it all happened suddenly in oil. But I do take your point, John, to watch the industrial metals and as well coal off of a China reopening is front and center for June.
TK copper higher, crude just a little bit lower.
It is a joy right now on this Friday as we regroup again for meetings with someone who stopped us in Davos a couple years ago. Savita Subramanian was in Davos with her Bank of America holding court on ESG. She's head of U.S. equity and quantitative strategy for the bank. Savita, time has marched on. ESG seems so yesterday's story, given record coal prices as well. How does the shock of these many global risks fold over into moving forward in the stock market? How do you regroup now to get ready for 2023?
Yeah, I mean, I think that where we are now
is, Tom, a tough time for ESG investors because the best performing areas of the market are hard to hold. Defense, energy, these are two areas that are typically excluded from ESG funds. So I think that's been hurting these types of investors. From a market perspective, I still think the worst is not behind us. We published yesterday that sort of a realistic worst case floor for the S&P 500 would be about 3,200. Here's the thing. I think when I talk to clients now, folks are asking me, give me any reason to be bullish right now. And I think the reasons to be bullish are the fact that clients are asking that question. There's a pervasive kind of fog of negative sentiment out there, which would argue that a lot of the bad news is priced in. I think what you want to buy at this point in the cycle is still very late cycle inflation beneficiaries. So we're still overweight energy. I think energy, to your point about China reopening, oil could be depressed right now, just given the fact that the second largest economy in the world is offline. I think that materials look less interesting to us, commodities and metals, because we are seeing some slowing trends in China, despite the fact that they are trying to, stimulate the economy. And we're also seeing a shift in demand from finished hard goods and, big ticket items to services. So under that backdrop, it makes sense to continue to go long oil, but, maybe move off of the raw materials.
Savita, long ago and far away, a guy named Ken Lewis was pilloried at Bank of America, and I always thought that Ken Lewis was brilliant on his Pacific Rim strategy. Bank of America didn't go into the Pacific Rim with their head cut off. They were very measured about it and attempted to be responsible. I want to know what you think about the bet on Pacific Rim equities given a China reopening. Is it worth playing, or do you stay in the U.S.?
I think you stay in the U.S. I mean, look, this year we've seen a very interesting re-rating of countries based on energy security. Countries that don't need to import oil are probably, kind of enjoying a unique advantage. And I think that, second of all, the U.S. is further along in terms of trying to stimulate the economy, trying to push up interest rates. We have corporates and consumers that are better capitalized. They've, basically gotten all this money from the Fed and the government. So I think that when I look at the U.S. relative to rest of world, I still think this is a year or two where the U.S. is going to continue to outperform rest of world. So emerging markets, to me, it still looks a little bit, potentially risky. Not to mention that if you look at our economists, they're revising down their growth forecasts outside of the U.S. much more aggressively than within the U.S. So I think those are all reasons to stay local, stay U.S. focused. Even small caps, I think, could do well in an environment where the U.S. economy is potentially, going to see a little bit of a lift if companies start spending again. Tom, I just want to say the most surprising thing to me during this earnings season is that even though all of these companies are guiding down and, very negative in terms of what they're expecting over the next couple of years, they're still guiding up on CapEx. They're still telling us they're going to spend more than we think they're going to spend. CapEx cycles are generally good for the economy. They're good for small caps. Maybe they're negative for the companies that have to spend the money, but I think it's interesting to see that CapEx is still a theme that companies haven't dialed back.
Savita, this week, staples have been absolutely hammered. Retail's really struggled. You've been on top of that story. I want to understand from your perspective whether we're confusing two things right now, the difference between how much the consumer is spending and how they're spending it. There seemed to be a massive focus on just the weakness, the signal that you were getting from the retailers that there was some weakness out there. Do you think the biggest story this week was just a shift in how they're spending, not how much they're spending?
I think the big shifts were how they're spending and also just, labor. There's a sort of a really dramatic shift in terms of undersupply to oversupply that we're hearing from companies. And that could actually benefit some of the more labor intensive areas of the consumer sector, like supermarkets, or, we haven't seen these companies perform well, but I think that where we are seeing a little bit of an alleviation is in terms of the labor supply. So that's, potentially a positive for margins. We're overweight staples for the long haul because our idea is as Ethan Harris, our global economist, continues to warn of rising recession risks, we think that staples, healthcare, no matter what, you still have to take your drugs and, eat your food. So defensive sectors to us still make a lot of sense. In a stagflationary backdrop, the best performing sectors are energy, consumer staples, utilities, to a lesser extent materials. You want to stay defensive and you want to overweight sectors that benefit from inflation.
Savita, you sound actually somewhat pessimistic, and yet your outlook for the end of the year is incredibly optimistic at a 4,500 target. Yes, 3,200 might be the low case. Are you thinking of downgrading the 4,500 as the base case? And if not, how do we get there?
Look, so, our target is made up of a few different factors, one of which is our house view on interest rates. And I think that is the swing factor. If you look at this year, most of the big moves that we've seen have been accompanied by a move higher in either real rates or the equity risk premium. Our view is that real rates continue to move higher, but rates volatility kind of abates. And we start to see, PE multiples essentially stabilize as rates volatility stabilizes. If that's not the case, we would be more negative. And I think that's the key factor to watch. Every tiny move in interest rates has an outsized impact on the S&P 500 in terms of, its longer duration. And we've talked about this on the program. The S&P 500 is now a 35-year zero coupon bond. It is super sensitive to the cost of capital.
Savita, are you saying this is Ethan's fault or Mark's fault? Whose fault is it?
Both.
I'll let you run.
I think they're both excellent, but
course.
we incorporate their views.
She's going to get out of this. We're watching.
Keep going.
Dig that hole.
No, we're done. We're done. Okay, Savita, thank you. Savita,
Brian,
appreciate it.
Yeah, Brian, I know.
Savita
She's digging a hole,
Subramanian
Brian.
of Bank of
Thank
America.
you so
That's
much.
They're all friends over there.
Yes.
Mark Cabana, Ethan
They
Harris, Savita. They are, Tom. They're all friends. I love that. 4,500 year end. Whose fault is it? Both. It's Mark's. It's Ethan's. It's not mine. It's not mine. Tom, future's positive, a little more than 1%.
John, it's serious stuff linking in the economics that we talk about every day to the market guess forward. And we got humility on that. It's always a guess forward. And I got to believe it's centered around, data dependency, but also expect the unexpected. What's the unexpected that's out there? I'm not sure what it is. I'm optimistic on China reopening.
I have to admit, Tom, if you told me equities would be down for a 7th straight week, I'm not sure I would have said the staples, Lisa, would be lower by 8-9 percentage points on the week, but it's been that kind of week.
It's been that kind of week as we realize that margin pressures are bigger than some people had expected, including the CEOs of the very companies that are experiencing them. How do we then parlay that into an outlook at a time when this might mean that they are not going to be raising prices on consumers as much, or they can't? Or, as we heard yesterday, maybe this means that they're going to just accelerate those price increases.
Savita touched on the big corporate story of the moment, the fact that we've gone from undersupplied to oversupplied, understaffed to overstaffed. Lisa, it's a story that you picked up on from Amazon to Walmart, then on to Target, and we're just seeing it all over the place now.
Yeah, and is this compositional, or is this something that is a wholesale retracement of the pandemic-era economy?
Futures on the S&P up by 1.1% from New York City. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. President Biden is in South Korea, the first stop of a trip to Asia, where the focus will be on the economy and security. The president visited a Samsung semiconductor plant and made the case for passing legislation to improve domestic manufacturing and supply chains. In Japan, he'll meet with regional leaders. The president wants support for his plans to aid Ukraine and counter threats posed by China and North Korea. Meanwhile, Bloomberg's learned that President Biden is considering a meeting with Saudi Arabia's Mohammed bin Salman as soon as next month. That would mark a shift for the president. He has avoided contact with the Crown Prince over the murder of journalist Jamal Khashoggi. By one account, the world has only 10 weeks' worth of wheat consumption in reserve. That is the lowest since the 2008 financial crisis. That's according to agriculture analysis firm Grow Intelligence. The firm's CEO, Sarah Menker, spoke to a UN Security Council meeting on food security. Other estimates aren't as dire. Still, high crop prices are putting millions at risk whilst grain supplies fall. And PIMCO and BlackRock are amongst the firms set to start debt talks with Sri Lanka soon. Bloomberg's learned that Alliance Bernstein, T. Rowe Price and Wellington are also amongst the members of a creditors group. Sri Lanka fell into default this week for the first time in its history. An economic meltdown has led to protests and a political crisis. SpaceX reportedly paid $250,000 to settle an employee's claim that she was sexually harassed by Elon Musk. According to the online news site Insider, the rocket launch company made the payment to a flight attendant who worked as a contract employee on the SpaceX corporate jet. Musk, who's the founder and CEO of the company, calls the accusations utterly untrue. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.